करो और मोबाइल से लॉगिन करो जना उसी
control is
so you share screen, what you do? You'll go to that particular folder and exactly.
Hello.
I should see myself in the video and also have the share screen. Both should stop.
Nitesh ji, am I audible?
Remove this case loss.
Umang, am I audible?
Yes, sir. Sir, you are audible, sir.
I'm audible. Raghavan ji has joined.
Yes, Raghavan sir has joined, sir.
Okay, then we should start.
Yes, we should start the meeting.
Okay.
Video.
Good afternoon, everyone, and a very warm welcome to all of them who have joined in and who are yet to join. I welcome Raghavan ji, Manish ji, Nitesh ji, Girdhari ji, and all my other friends who have joined in. Today we have a very vital topic which is titled as Development Agreement and Revenue Sharing with respect to taxation issues. This subject will be dealt in with by Ashok Raghavanji from Bangalore. And after him, CA Manish Gadia ji from Mumbai will take GST on real estate. Sir, one announcement to you all. Today there is some technical problem going on in Zoom, though we have joined 100+ participants, but few of them are not able to join. So I'll request if anybody receives any call from anybody for not joining, so just guide them that it is a technical issue. They may try, or else it will be resolved automatically. We are not ready to guide to our fellow colleagues on this technical issue at this moment. With this, I request Nitesh ji to take over the proceedings. Nitesh ji. Nitesh ji.
Yeah, thank you, Saroj ji. Friends, last 2 days were a little bit tough for our CA fraternity when the Deputy CM of the UP, he has made some derogatory remarks for chartered accountant just to please the cost accountant at their seminar. So we fraternity, the CA fraternity, we all together use the social media as a vehicle to express our displeasure and our today he has just sent one we had received one video that in which he has just expressed his what you can say that he little bit we are fortunate that he has sent the video expressing their expressing his means hello hello
Hello.
am I audible?
Sir, you are audible, sir.
Okay. So friends, as we all have in the social media, we have used that to express our unpleasantness. That is why such thing has happened. So in future, we have to, for any other things happen in future, we have to show the unity amongst us. I welcome the today's speaker, Mr. Raghavan, Mr. Manish Gadia, who had been the chairman of the WIRC in last year. So welcome to both of you, sir. With these, may I now request Girdhari Lalji Sharma to kindly introduce both the speaker, please.
Thank you, sir. I welcome C. Ashok Raghavan, sir, who is from Bangalore. He is commerce graduate from Bishop Cotton College. He is a chartered accountant in practice since 1993. He has more than 29 years experience in direct tax. He is basically expert in foreign exchange, drafting of agreements, documents. He is active member of Bangalore branch of SIRC of CA Institute. He was the treasurer, secretary, vice chairman of the Bangalore branch of SIRC. He has published a book on tax audit. He is associated with Karnataka State Cricket Association, and he is in the management committee of the various charitable trusts and organizations and government bodies. He is also attached with Bangalore Turf Club. He is a Rotarian, and he is also attached with Federation of Karnataka Chamber of Commerce. A person who has widely traveled and has attended and given lectures on various topics of the interest of our members. He is a regular contributor of the articles in the study circle and the institute. With these words, we welcome CA Ashok Raghavan, sir. Next speaker of today's evening is CA Manish Gadia. He is from Bombay. He qualified as a chartered accountant in 1997. He is partner in GMJ and Company Chartered Accountant. He is basically practicing in the GST field. He has co-author and book research paper on the various subjects: statutory obligations, cooperative housing society. He is co-author of the book of handbook on valuation and handbook on EPC contracts. He has attended various seminars of the institutes. He is the past chairman of Western India Regional Council. He has attended leadership role as a past chairman of Professional Development Committee and Study Circle. He has contributed papers on the GST at various seminars and presentations. With these words, we welcome CA Manish Gadia, sir. Thank you, sir. We welcome both the speakers. Hello. Yes, sir.
So, ladies and gentlemen, can I start my session?
Yes, sir.
Raghavan sir, can you start the session, sir?
Yeah. Mr. Giridhar Lal Sharma, Mr. Nitish More, and Mr. Manish Gadia, co-speaker for today's session. Good afternoon to all of you. It's definitely a privilege to attend, to address the members of the Views Exchange study circle, which I believe is one of the largest study circles in India and the most prominent one in the city of Joy, Kolkata. My tryst with the Chartered Accountants of Calcutta actually started with a seminar conducted by the Views Exchange in the year 2012 on Section 194 IA and Section 43 CA and 56.7. And from 2012 onwards, I've been a continuous faculty in the Eastern region, especially in Calcutta, in Guwahati, and 2 months back, even in Bhubaneswar, when Mr. Nitish More wanted me to present it at the Regional Conference of Chartered Accountants at Bhubaneswar. So therefore, my affinity with Views Exchange starts in 2012 and continues till date. I have fond memories of some of your eminent members like Vivek Navatia and Mohit Bhuteria, and all of them have become my personal friends as well. Now, as we have started
So a decade of connection with the Views Exchange, sir.
Yeah.
A decade of connection with the Views Exchange, we can celebrate it. A decade of connection.
Yeah, a decade of connection with Views Exchange, you're right. So, again, thanks to Mr. Nitish More, I am here today to address on this topic of tax and other implications on development agreements, both area sharing and revenue sharing. As I've addressed this session many times all over the country, especially the Eastern region, some of you who are on the show today may have already listened to me a couple of times. However, even at the cost of repetition, I would be forced to dwell through this entire topic in a matter of 1 hour. Although I can take the same topic even for 4 hours or 5 hours, with the limited time available at my command, and very well knowing that Mr. Manish Gadia ji will be waiting in the wings to take it on the GST aspect of the development agreements, I will straight away go to the topic on hand. First, I will share my presentation, and then if one of you please confirm that it's visible. Yeah, is it visible?
Yes, sir.
Yes, visible, visible.
Visible. Okay. So
Visible,
therefore, let us understand from this development agreement as to what is the nature of the transaction. First page. Basically, this development agreement became a sort of flavor of the real estate market around the 1970s, when the landowners realized that they had land which has either been inherited by them or bought by them, quite large pieces of land, and they were unable to monetize the same in an effective manner because of lack of capital, lack of competency in construction, lack of a brand name and image to sell any construction which they would have developed on their own. So they were therefore forced to find people who had competency in construction, who had the financial capability, who had the brand name, and who literally had the marketing ability to ensure that this particular real estate development is completed and sold to prospective buyers. So basically, this entire concept of development agreement is because the developer could not, lock his capital in buying land which is very, very expensive, especially the metro cities and the premier cities of India. And the owner did not have the capital to do the construction. So it is a marriage of convenience between the two parties as to how this development agreement came into vogue in the real estate industry. Now, what is the nature of this transaction? First, the few slides will be dealing with the area sharing agreements, and then the next few slides will be going to the revenue sharing arrangements. Now, when we come to area sharing, what is the nature of transaction? It is basically that the owner and the builder or developer enter into what is called a development agreement. I refuse to, and I appeal to our members, never use the word joint development agreement. That is only in common parlance. When you go and do a legal document, use the word only a development agreement, because in actual fact, the owner is not doing any development at all. In fact, your preamble says very clearly that the owner did not have the financial capacity or the ability to develop on his own. And therefore, he approached the developer, or the developer approached him and decided that they will develop this property through the developer. Therefore, the question of joint development doesn't arise at all. Because of the loose terms being used by convention, we have got a lot of trouble with the tax authorities, with some of them saying that it's an association of persons between the two people. Some of them saying that the landowner should be equated to the developer under the method of accounting to be followed by the developer, etc. So please do not use the word joint development. Use the word only development agreement henceforth. If you have already stopped using the word joint development, I'll be more than happy.
No.
Now, therefore, the owner and developer enter into a development agreement where they agree to develop this particular immovable property into a residential or a commercial complex. They also identify as to what is going to be their sharing ratio, say 40% to landowner, 60% to the developer. And then they apply for the plan sanctions by giving a GPA on the same day to the developer to do all acts, needs and things in furtherance of the development. The developer applies for a plan sanction, various permissions, clearances and licenses for the purpose of the development. And once the plan sanction is received, both the parties enter into what is called an allocation agreement, wherein the percentage which was originally agreed in the development agreement is actually percolated down or transcribed into the actual area to be allocated to the landowner and actual area to be allocated to the developer, more or less on the same percentage, except for a fractional difference. And they will also identify the floor or the blocks in which their respective shares are going to be allotted to each of them. So I repeat, we will have this agreement wherein first they agree to share a percentage. After all the plan sanction and clearances are obtained, they will enter into an area sharing agreement where the specified areas will be identified between the landowner and the developer for retaining them and selling them to their respective prospective purchasers. Now, the important point of this is that the developer gives a license, the landowner gives a license to the developer to enter the property and occupy the property for the limited purpose of development. I repeat, the owner gives a license to a developer to occupy, not possess, to occupy the property for the limited purpose of development as agreed to between the parties in terms of the development agreement. This license is something which is akin to a license as understood under section 52 of the Indian Easements Act, and therefore cannot be taken as a possession given to the developer in part performance of the nature of a contract as referred to in 53A of the Transfer of Property Act. What used to happen was, most of the cut and paste development agreements used to only put one line that the possession given to a developer is not a possession as of the nature referred to in 53A of the Transfer of Property Act. And with that one line, they thought that they will be escaping the tax incidence on the date of signing the development agreement. But when we started getting adversarial decisions, right from the decision of Chaturbhuj, Dwarkas, Kapadia, Bombay High Court in 2003, 260 ITR, we put our thinking caps on and we started improving our way of writing the development agreements. So therefore, when we draft an agreement, we clearly mention that the license given to a developer is for the limited purpose of occupying the land for the purpose of development under a license as understood under section 52 of the Indian Easements Act, and such a license cannot be considered or construed as a possession given to the developer in part performance of a contract of the nature referred to under section 53A of the Transfer of Property Act, read with section 2 bracket 47 bracket 5 of the Income Tax Act. So such an elaborate clause has to come. Further, one more clause should be supplemented to say that it's agreed and understood between the parties that the legal domain, I repeat the word, the legal ownership, domain and control of the property continues to vest with the owner till such time the same is sold in whole or in parts in undivided share to the purchasers of units or apartments in the project. I repeat, you have to add one more line to clearly state that the legal ownership, domain and control of the land continues to vest with the landowners till the same is transferred to the purchasers of units of apartments or commercial units in the project. These two are certainly very key lines to be included in a development agreement. And I will tell you why when I come to the later part of my slides. Now, we will also be adding some standard clauses in the development agreement, giving the right to the developer to mortgage the developer share of interest in the property in favor of the lending institution for construction finance. We will be giving the original title deeds to be kept in escrow, and later on we'll be handing over the original title deeds to the financing entity who's providing construction finance to be kept by that financial institution in trust for both the owner and the developer, and to be returned by the institution to the association to be formed by us after completion of the development, on the entire loan being repaid by the developer to the financial institution. That is one more clause which we will be adding in the agreement. Then we will be having a clear agreement, clear clauses in the following manner as far as the time of commencement and completion of completion of the project is concerned, we will have 3 timelines. There will be one timeline for the number of months required to obtain a plan sanction from the date of agreement. There will be one timeline for the commencement of construction, number of months to commencement of construction after receipt of plan sanction. Third, there will be one more timeline for the number of months to be taken to complete the development from the date of commencement of construction. I repeat, there will be 3 timelines. One timeline for the number of months to be taken to obtain plan sanctions, other permission and clearances. Then the number of months to commence construction from the date of plan sanction. Then the number of months to complete the construction from the date of commencement of the construction. So these 3 clauses should also be clearly embedded in the development agreement. Then we have to make a standard compensation clause to be paid by the owner and the developer as per RERA. We should not have differential compensation clauses for the developer share of buyers and the owner share of buyers. Then there should be an agreement for price parity, where both the parties should agree on the launch price and both the parties should agree on the price at which the minimum price at which the apartments or units should be sold in by meeting every quarter, depending on the average sale price achieved in the previous quarter. Why this clause is important is because then only you will have control over the rates at which the developer and owner are selling their respective shares, and one will not be undercutting the other, thereby detrimentally affecting the project and its viability. Next, we will also have a clear clause to say that the developer will be responsible for all acts, needs, and things relating to development and construction, whereas the landowner will be responsible for the title to the land on which such development is going to be carried on. So these 2 clauses will also be there. Then, most important, we will be having a clear clause to say that the developer will have the right to enter into agreements, to collect advances, to collect deposits, to collect GST, etc. from his share of buyers in the project. However, his power to execute a sale deed in favor of his buyers will be given to him only after the OC of the project is obtained, the occupancy certificate is obtained, and only after he hands over the owner's share of super built area in habitable condition to the owners after a joint inspection between the 2 parties. This clause is again mandatory to prevent the sale of the developer share prior to receipt of the OC, which is also one of the mandatory conditions under section 17 of RERA. Now, most importantly, because of the new laws in force, that is RERA and GST, we literally have to draft elaborate clauses on RERA and GST. The type of clauses which I draft in development agreements is more than 1 page for RERA clause alone and more than 1.5 pages for the GST clause alone. Since Mr. Manish Kadia is going to develop on the GST, I'll just probably touch upon it. So therefore, I'm not getting into the detail of the drafting of the clauses, but it's most important to tell you that under the present laws, it is most essential for you to draft elaborate clauses relating to RERA and GST in a development agreement. Now, what are the issues which have confronted us on the taxation aspect of development agreements? And why did these issues come about? And where do they presently stand? And what are the ways out of, or what are the ways to combat these issues if you or your clients are going to be faced with such issues? This is a short and moot point on which I will dwell upon in the next 45 minutes. Now, the biggest issue which we faced from 2003 onwards was due to the decision of Chaturbhuj Dwarkadas Kapadia versus CIT 260 ITR 491 by the Bombay High Court, where the Bombay High Court had, based on that particular transaction, held that the possession given to a developer in pursuance of a development agreement is akin to a possession taken by the developer in part performance of the nature of a contract referred to in 53 of the Transfer Property Act, and therefore held that there is going to be a capital gain arising on the landowner on the date of entering into the development agreement itself. After the decision of Chaturbhuj Dwarkas Kapadia, there were a plethora of decisions. In Karnataka High Court, we had the decisions of Dr. T.K. Dayalu, Ved Prakash Rakra, H.P. Jairaj, etc. In Andhra Pradesh High Court, we had Potla Nageshwar Rao. Then we had Jasbir Singh Sarkaria, Authority of Advance Ruling. We had hundreds of decisions which came uniformly in favor of the revenue to say that the possession given to a developer to enter the property and commence construction is a possession retained by the developer in part performance of the nature referred to in 53A, and therefore there is a trigger of capital gains on the landowner at that point when he enters the property to construct, and therefore the landowner was to pay capital gains tax on the date of signing the development agreement itself. Now, this particular adversarial decisions created a mayhem as far as landowners were concerned, because the landowners had no money in their hands to go and pay the tax, but the tax department conducted surveys on the builders. They took sworn statements from the builders. They took all the dates of commencement of the development agreement, the date of entering the property for starting work, the plan sanction date, the OC date, the date of handover of the owner share of super built area, etc. And based on all this, they then surveyed or searched the landowners, made them, made them undertake sworn statements either under one section 132(4) or under section 131, forced them to pay tax on the date of entering into the development agreement itself. And the landowners were put into huge amount of hardship on this particular on the particular stand taken by the Revenue Department based on these adversarial case laws. Now, why were these decisions rendered in that particular way? What was the analogy on which the courts held in that manner? The court simply held that the developer does not only have the right to come and develop the property, he also has a right to mortgage his developer share in favor of a developer. He has got the right to collect advances. In some cases, he also has the right to go and sell his developer share of right, title, and interest in the undivided share of land and the super built area without having to take permission from the owner for which he had already obtained the TPA. And therefore, in effect, the domain and control of the land had already been ceded by the landowner to the developer, and therefore there is a taxable event arising under section 2(47)(5) or 2(47)(6) of the Income Tax Act, and therefore the owner had to pay tax on that day itself. Now, these decisions, be it that may, were confronting these assessors, as I said, especially landowners who were put into a huge amount of hardship. Now, how these notices or these proceedings initiated by the department by confronted by us as professionals is what I will share, and what you can confront even today if you get such notices. What I will share with you a few points so that you will be able to combat these type of cases which come to you, or combat such notices if continue to be received as far as joint development agreements or development agreements are concerned. Now, point number one. Okay, before we go to the combating of the cases, I will also dwell upon two more aspects. So when these notices came to us, we thought we are doing a very good job of trying to protect the interests of the landowners. So we went and filed replies to state that the transfer does not take place on the date of signing the development agreement. It actually takes place only when the developer actually enters the property for the purpose of construction, which is a manifestation of his intention to perform his obligations under the development agreement. Because section 53A had a mandatory condition that not only it should be for a transfer of a immovable property, both the parties to the transaction should have been willing to perform their respective share of obligations. That was one of the essential conditions. So we started replying saying that the developer's intention to perform his share of obligations under the development agreement arises only when he actually does some act like entering the property and commencing development. Therefore, the capital gain should not arise in the year when development agreement is signed. It should arise only in the year when actually some development or construction is started on the property. Now, based on this analogy, there were several decisions rendered by various tribunals, including a High Court, that the capital gain doesn't arise on the date of the development agreement, but it actually arises only when the developer enters the property and actually physically does some construction activity, thereby manifesting his intention to perform his obligations under the development agreement. Now, all these, the screen which I'm sharing, I will share with Mr. Nitish More later on. He can give it to all of you for your posterity and for referring to all the case laws. Now, why the second aspect was important is because we found that very interesting, especially when certain landowners did not want to pay tax on the construction cost of the super built area which was received by them, but wanted to pay tax on the land area given up by them to the developer under the provisions of Section 50D, which came into the statute only with effect from 1/4/2012, where clients had entered into development agreements in the fag end of the year 2011 or in the early of 2012. We used to then advise them to postpone the actual delivery of possession to the landowner to commence construction post 1/4/2012, so that they could adopt Section 50D for the purpose of arriving at the deemed value of consideration, and they did not adopt the cost of construction of the developer's owner share of super built area. Wherever the guideline value of land was very low, it helped us to get a lot of relief for the landowners to push them under the provisions of Section 50D, rather than make them pay tax on the deemed value of consideration of the construction cost on the landowner share of super built area incurred by the developers. Now, now there are the third batch of case laws which I have given in the handout. There were few of them which held that, especially Atam Prakash of New Delhi, Naju Demu Daro of Allahabad, and the CAT Karnataka, Bangalore versus Sadia Sheikh, High Court of Goa, Mumbai and Goa. Some few decisions like that held that that the possession given to the developer was only a license and a permissive possession. It was not a possession which was deemed to be a possession under 53 of the Transfer of Property Act, and therefore there was no capital gains arising on the landowner at the point of the development agreement. That the capital gains arises only at the point of time when the owner actually receives a share of super built area in the project. Now, those decisions were few, but they were far between. But even when those decisions were there, the department was not accepting those decisions and were continuing to go with the decisions which were in their favor, which were plenty. Now, when we used to receive notices under Section 148 for reopening, or when we were forced to go and declare a particular capital gain under a sworn statement under 132(4) or 131 as the case may be, and when we were confronted with such notices, we used to advise the clients that the analogy rendered by all these adversarial decisions are incorrect for the following reasons. One, we were if you look at the provisions of Section 53A of the Transfer of Property Act, the wordings are very, very clear in Section 53 of the Transfer of Property Act that it is that the agreement is between the transferor and the transferee, and the transferee should be the one who is willing to perform his share of obligations. Now, the moot point which arose for consideration is whether the developer can be considered as a transferee for the property. Now, It is very clear from the wordings of section 53A, as I said, where a person contracts to transfer for consideration any immovable property by writing signed by him on his behalf, from which the terms necessary constitute the transfer can be ascertained with reasonable certainty, and the transferee has, in part performance of the contract, taken possession of the said property. So it was the transferee who should have taken possession. A developer who is basically a transient entity in the scheme of things, he only comes, develops and walks out after selling. He could never be regarded as a transferee. It is only the end buyer who could have been regarded as a transferee. So by the provisions of section 53A itself, the question of transfer or to a developer by the landowner did not arise. Then we also depended on the provisions of section 54 of the Transfer of Property Act, which talks about a contract for sale. Now the moot point which we need to dwell upon is whether a development agreement is a contract of sale or a contract for sale. It is very clear that the development agreement depends on a contingent occurring of events for it to happen between the landowner and the developer for there to be a transfer. Therefore, it can never be a contract of sale. A development agreement is a contract for sale. When a development agreement becomes a contract for sale, then the provisions of section 54 of the Transfer of Property Act come into play. When section 54 comes into play, a reading of section 54 of the Transfer of Property Act, which I will reproduce, states that a contract for the sale of removed property is a contract that a sale of the such property shall take place on terms settled between the properties. It does not, comma, of itself, comma, create any interest or charge on such property. It is highly relevant to note that a development agreement is a contract for sale and not a contract of sale. And section 54 clearly says it does not of itself create any interest or charge on such property. Therefore, a development agreement cannot create an interest in favor of the developer at the point of development agreement, because a development agreement is a contract for sale and not a contract of sale. Then we also went and depended on certain judicial pronouncements which are very interesting to read and also use to your support. One was the case of CIT Govind Saran Gangasaran was Commissioner of Sales Tax, 155 ITR 145 Supreme Court, where in that case the Supreme Court came up with a very good principle attached to taxing a particular person under a statute. It said that the components of which would enter into the concept of a tax are well known. I repeat, the Supreme Court held in Govind Saran Gangasaran's case that the components which enter into the concept of tax are well known. The first is the character of the imposition known by its nature, which prescribes the taxable event. The second is a clear indication of the person on whom the levy is imposed. The third is the rate at which the tax is imposed. And the fourth is the measure or value on which the rate will be applied for computing the tax liability. The Supreme Court therefore gave 4 principles to be looked into for it to be comprehensively taken as a taxable event. 1, the character of the imposition known by its nature, which prescribes a taxable event. 2, the indication of the person on whom the levy is imposed. 3, the rate at which the tax is imposed, and most important, the value or measure on which the rate of tax will be applied. In the case of a development agreement, arguably the first 3 limbs can be said to have been met. That is, we know the imposition of the character of the levy, we know the person who has to be taxed, we know the rate at which he has to be taxed. But the 4th limb, at the point of development agreement, did you know on what value, on what measure you have to levy the tax? The answer was an emphatic no, because at that point of time, the commencement of construction had not started. there was no measure or value at which you can futuristically decide today that this is the value on which I will get in return the super built area for having given up X amount of area of my land. Therefore, the fourth component of the taxable event fails, and using Govind Sir and Ganga Sar's case, we have successfully rebutted the argument of the department that there was a taxable event at the point of signing the development agreement. Next, we also use the observations of the Supreme Court in the case of Ishika Wajima Harima Industries 288 ATR 408, wherein the Supreme Court held in orbital dicta in that ruling that in construing a contract, the terms and conditions thereof are to be read as a whole. A contract must be construed keeping in view the intention of the parties. No doubt the applicability of tax laws would depend upon the nature of the contract, but the same should not be construed keeping in view the tax provisions. The Supreme Court said, in construing a contract, the terms and conditions thereof are to be read as a whole. A contract must be construed keeping in view the intention of the parties. No doubt, the applicability of tax laws would depend on the nature of the contract, but the same should be construed keeping in view the taxing provisions. So therefore, they held, first of all, the commercial understanding of the parties is sacrosanct. The legal understanding of the parties in the agreement is sacrosanct. Now, if I'm writing in the agreement that the legal title, domain, and control continues to vest with the landowner till the same is transferred to the buyer, and the possession given to the developer is only a license under 52 of the Easements Act and is not a possession under 53 of the Transfer of Property Act. And I also write very clearly that the domain and control continues to vest with the landowner, then the legal agreement and the commercial arrangement between the landowners is sacrosanct, and the tax authorities cannot view it isolatedly, only keeping the tax provisions in mind. They should take this commercial and legal understanding as a whole. Next, therefore, keeping all these aspects in mind, namely, one, Section 53A wordings of the Transfer of Property Act clearly state or clearly indicate that the developer is not the transferee. Section 54 of the Transfer of Property Act talks about contract for sale, which is akin to a development agreement, which says that no interest also is created in the favor of the developer. Third, Govind Sir and Ganga Sar's case, where the value of the taxable event fails. 4 is Ishika Wajima Industries versus CIT, the Supreme Court decision, where the contract has to be read as a whole. So therefore, we were very clear that this did not apply, but however, the tax authorities continued to act upon the decisions of Chaturvij Kapadia, Dayalu, etc., etc. Now, the icing on the cake finally came after a prolonged struggle by us in various judicial fora, with the decision of the Supreme Court in the case of Sheshasai Steels Private Limited versus ACIT 421 ITR 46 Supreme Court in December 2019. In this decision, for the first time, the Supreme Court categorically went into the entire nature of transaction between the developer and the landowner, and based on clause 16 of that particular agreement between the landowner and the developer, the Supreme Court gave a clear ruling that the permission given to a developer to enter the property and construct does not become a possession in part performance of the nature referred to under 53A, and therefore such a permission given cannot be considered or construed as a taxable event, asking for the landowner to end up paying capital gains tax on the date of signing the development agreement. While holding so in Sheshai Steel's case, the orbital dicta, a particular paragraph, is of critical importance. What the Supreme Court held is thus: clause 16 would therefore lead, clause 16 of that agreement, which was before the Supreme Court, would therefore lead to the position that a license was given to another upon the land for the purpose of developing the land into flats and selling the same. Such license cannot be said to be possession given within the meaning of Section 53 of the Transfer of Property Act, which is a legal concept and which denotes control over the land and not physical occupation of the land. This being the case, Section 53 of the Transfer of Property Act cannot possibly be attracted to the facts of this case for this reason alone. Now, based on the Obita Dicta and the ruling of Supreme Court in the case of Sheshai Steels Private Limited, which is now duly supported by the decision of the Madras High Court in Sumere Soft Private Limited, which is also taken on the made on the basis of the ruling in the case of Suraj Lamps and Industries Private Limited, where the Supreme Court held that transferring a property through a GPA is not a correct way of doing things. It is only the conveyance through a sale deed which will actually pass on title. Based on these case laws, which are finally dawned on all of us, I would now emphatically state in this particular program that the decisions of Chaturbhuj Dwarkadas Kapadia, Dayalu, and all about 40-50 adversarial decisions given in the country are now a dead law. And we need not worry about these case laws anymore. Once, and even if the department initiates any proceedings that they were doing all this while, you can take support of whatever I've stated in the last 15 minutes to emphatically and successfully rebut the department's view on the matter. Now, there was another ruling which was, I just want to pass this ruling for a minute, where, there were a few more rulings which talked about the taxable event in the case of unregistered development agreements. The case finally reached Supreme Court of the case of Balbir Singh Maini, wherein the Supreme Court categorically held that due to the amendment created by the Registration and Other Related Laws Amendment Act 2001 with effect from 24/9/2001, wherein amendments were effective to Section 17 of the Registration Act and 49 of the Registration Act, wherein it was held that if a document is not registered, it has no effect for the purpose of Section 53A. Based on that particular amendment, the Supreme Court held in Balbir Singh Maini's case that in the case of an unregistered development agreement, there is no taxable event on the landowner as on the date of signing the development agreement or on the date of commencement of the construction activity. The taxable event can be successfully postponed till the date when he actually receives a share of constructed area in the project. Now, because of this adverse stand taken by the department, till we now have the rulings of Sheshai Steels and Sumero Soft, etc. Till we had these rulings, we were faced with a very peculiar situation where the landowners were asked to pay tax without money in their hand. The small amount of refundable and non-refundable deposit was not good enough for them to pay tax on the entire developer share of land which had been transferred, which had been handed over to the developer in return for a super built area. So we went with the advice of, or the famous English adage of prevention is better than cure. So what we started doing is we advised our clients to convert their land into stock and trade and then enter into a development agreement. Now, if it was a proprietor, we used to make him swear an affidavit that he has now converted his capital asset into a stock and trade, taking into consideration that he wants to monetize that land, he wants to develop a residential real estate development on that particular property, and considering the surrounding areas and the development therein, the proprietor wanted to therefore convert his capital asset into stock and trade in the case of a proprietor. In the case of a partnership firm or LLP or a company, it was very easy. We used to simply change the objects and bring in the objects of real estate and convert this property from a capital asset to stock and trade, thereby triggering the provisions of Section 45(2) of the Income Tax Act. Now, by doing this, prevention is better than cure. How did we manage to combat the same adversarial notices? We successfully argued before various tribunals and finally before High Court, that where the owner has held the property as a stock in trade, the proprietor has no right to convert the stock in trade. Therefore, the proprietor has no right to convert the stock in trade. Therefore, the proprietor has no right to convert the stock in trade. Therefore, the proprietor has no right to convert the stock in trade. the decisions of Chaturbuj Kapadia, Dayalu, etc., does not apply for the simple reason that all those decisions that said that the transfer has taken place in accordance with the provisions of 53A of the DP Act, read with section 2(47)(5) of the Income Tax Act. Now, transfer under 2(47), as you all know, is only in relation to a capital asset. Now, 2(14) capital asset does not include stock in trade. Therefore, harmoniously reading the provisions of 2(47), read with section 2(14) of the Income Tax Act, we had safely concluded that transfer of stock in trade is not contemplated under 2(47), and consequently, when a stock in trade is transferred, the deeming fiction created by 2(47) does not apply, and the normal law, which is the normal provisions of the Transfer of Property Act, be it section 53 or 54, will apply only when such land is transferred to the ultimate transferee, either by handing over possession or by registering the property in favor of the transferee, whichever is earlier. So, I have now finished the first part of it, where as far as point of taxation is concerned, I made it very clear to all of you, nothing to worry anymore. Based on what all I've stated in the last 10 minutes, please be rest assured that you can take a very strong stand that there's no need of the owners paying tax on the date of signing the development agreement in the period prior to 1/4/2017, when section 45(5)(a) came into the statute. So all this will help you for landowners taxation in area sharing development agreements entered into by individuals or HUFs prior to 1/4/2017. Now, next issue which cropped up was, now having determined what is the point of taxation, now the debate is, what is the consideration to be taken for the landowner for the purpose of transfer, which is the basically the essential ingredient required for computing capital gains under section 48. So what is the consideration for the purpose of transfer? So there are a host of decisions which clearly held that the cost of construction incurred by the developer on the owner's share of super built area will be equal to the sale value of land which has been given to the developer as which has been taken as a developer share in the development agreement. I repeat. So one view was the consideration for the purpose of transfer, for the purpose of computing the capital gains of the landowner, should be taken as the cost of construction incurred by the developer on the owner's share of constructed area, plus the non-refundable deposit given to the owner by the developer. This view has been supported by various decisions which I have listed in this particular slide, like NS Nagaraj, Kivraj Motors, Ved Prakash Rakra, S.A. Taroka, Vasvi Prasad, Uday Hospital, there are many of them. Now, this is not the end of the story. So, therefore, one view is that it should be on the replacement cost, which is nothing but the construction spent by the developer on my share of super built area. The next issue is, can we simply take the certificate given by the developer for this purpose and say that that is the value on which I need to go and pay my tax as a landowner? The developer can give any certificate without any basis. So does that become the basis for me offering the tax or for the department levying the tax? The answer is no. All the decisions which I've given in the handout, especially the decisions of Kivraj Motors, Ved Prakash Rakra, Uday Hospital, and Vasvi Pratap Chand, have categorically held that the cost of construction which is given by a certificate by the developer need not necessarily be taken as the consideration for the purpose of transfer by the landowner, because it is invariably the case that the cost of construction of the developer, which he incurs on the entire project, would be including his finance cost for having borrowed money for the construction, would be included his marketing cost, will be including his administrative cost of having staff, which are not looking only into this project, but looking to other projects as well. It can have so many overheads, general overheads, which are apportioned to this project. All that will be taken as a cost in the developer's books as far as this project is concerned. but the actual cost of the landowner share will obviously be only the lime, brick and mortar which is embedded in the landowner share. You cannot add all the general overheads and the apportioned overheads and the finance cost to the cost of the construction of the landowner share, because from the development agreement itself, it's very clear that the developer has to meet the cost of construction of the landowner share. Whether he borrows, whether he takes it from his own source, is none of the concern of the landowner. So, therefore, there are two things. One, for people who want to take the cost of construction as a consideration for the purpose of transfer, I've given you various case laws which can be used. Second is, if the department wants to foist upon you that the whatever certificate given by the developer is sacrosanct or is to be taken, please combat them with all these decisions given to you by stating that their certificate need not necessarily be the cost. The cost can be far lower than what they have actually incurred due to other costs which are not incurred on my share, which has been loaded onto this project by the developer. Next, we had an alternative from 1/4/2012 onwards, where we started telling the assessees that wherever we find that the guideline value of land was much lower at the point of entering into the development agreement, rather than wait for the construction cost to be determined after receipt of the construction area at a future point of time, we advise them to go and subject themselves to tax under Section 50D of the Income Tax Act, wherein which came into the statute with effect from 1/4/2012. I think somebody is speaking there, sir. If all of you can mute, I'll be grateful. Yeah.
It's muted, sir.
So all I'm saying is, so we used to advise the clients to go under 50D and pay tax on the transfer of the developer share in land based on the guideline value of the land which has been given to the developer's nominee as part of the developer share. So in other words, where we found this convenient, we used to ask our assessees to adopt Section 50D. However, Section 50D can be adopted only for where the transfer takes place after 1/4/2012. And in the case of individuals and HF, where the transfer is completed prior to 31/3/17. So after 31/3/17, individuals and HFs cannot go under 50D. Whereas a company, an LLP or a partnership firm which owns land and which has given it for development can still go under Section 50D even today, as long as they have held that particular land as a capital asset in their books. Now, let's come to 45(5)(a). When 45(5)(a) was enacted into the statute, I was squarely disappointed because people who used to, what is the time? Who used to consult me on, especially joint development taxation, they were actually very satisfied or elated with the amendment to Section 45(5)(a), which came into effect with effect from 1/4/2017. Now, if you read Section 45(5)(a), the following important aspects need to be noted. One was that this applies only to an individual or HF and doesn't apply to a firm, company or LLP. It applies only to an area sharing agreement and not to a revenue sharing arrangement. It applies to a development agreement entered into on or after 1/4/2017. It is only prospective in nature and cannot be applied retrospectively. I repeat, 45(5)(a) applies only to an area sharing and not to a revenue sharing arrangement. It applies only to a development agreement signed on or after 1/4/2017. And it applies only to an individual HF, not to a company, OP or, firm or LLP. Furthermore, it is only prospective and not retrospective as held by two tribunals. Furthermore, if you look at 45(5)(a) carefully, please be rest assured that it is not a very conducive way of offering your landowner share to tax. The reason as follows. You look at the careful wording of 45(5)(a), it clearly says that the transfer takes place on a date of signing the definitive agreement, but specified agreement, but only the capital gains is postponed to the year in which the OC is received. I repeat, the transfer takes place on the date of signing the agreement, but the payment of capital gains is postponed to the date of entering into the on the date of receipt of the OC. Therefore, when people are looking at investing in bonds within 6 months under 54 EC, or constructing a house within 3 years or 2 years, as the case may be, for buying a house, then the trigger date is the date of signing the specified agreement, not the date of payment of capital gains. So be very cautious about this. If you go under 45(5)(a), your transfer has taken place on the date of signing the agreement. So your trigger point for constructing a house or buying a house or investing in bonds starts from the date of signing the specified agreement and not from the date of payment of capital gains, which is at the point of OC. So be very careful about this. The second part of 45(5)(a) is that you end up paying much more tax, because what is taxed is the guideline value of the building, which is returned to you in lieu of the land given to the developer. First of all, how do you ascertain only the guideline value of the building? That is going to be a contentious issue. And if you ascertain the guideline value of the building, you find that the value is much more than what you would have otherwise paid under Section 50D or under the cost of construction method. So therefore, Section 45(5)(a), which actually thought will be providing some relief to the landowners, is not exactly a relief. Now, the other important aspect is, in the case of an area sharing agreement, when I'm getting my apartments from the developer, say in the year 2022, although I've entered into a development agreement in 2018, and today I get my share of apartments, and I've already entered into agreements to sell my share of apartments to so many buyers, and the very next day, I hand over, or within a few weeks, I transfer my share of apartments to the buyers to whom I've already entered into agreements with. The question is whether the building will become short-term and the land will become long-term as far as my share of apartments are concerned. Here, the traditional view would be that the land will be long-term and the building will be short-term. Therefore, it's very advisable to enter into an agreement for selling your share of apartments, wherein the margin for the sale price for the building should be mentioned very clearly and independently, and the land price should be mentioned clearly, and the building price should be mentioned in such a way that it's only slightly above the cost of construction which has been determined by the developer and given to you. So if at all there's a short-term capital gain, you will pay it on a very marginal share. The entire share will go on long-term capital gain for the land sale. Now, the adventurous argument in this regard can be that if I've entered into an allocation or area sharing agreement in 2019, I did a development agreement in 2018. I entered an area share in 2019. I got completed apartments in 2022. And there are more than 36 months since I entered into an area sharing agreement. I've taken possession today. So the right to receive my apartments crystallized on the date of receiving my allocation agreement. So the right to receive apartments itself is a capital asset. Therefore, when I transfer this building in the year 2022, along with my land, both are long-term and not short-term. So this is another argument which you can look at taking when it comes to finding out what is the type of tax the owner has to pay on this particular transaction. The revenue has also taken a call in some cases that since the landowner is getting a plenty of apartments in return for his land, he is now indulged in an activity which is akin to an adventure in the nature of trade, and therefore whatever he's going to sell, it automatically becomes by default a business income and it is not a capital gain. To this, I have also listed down a few of the decisions, including that of the Calcutta High Court and Rupta Properties, wherein they have clearly said that just because the landowner is giving his land and getting plenty of apartments or units in return, it does not amount to him having indulged in an activity which is akin to an adventure in the nature of trade, and therefore he will be taxed under the head capital gain only and not under the head income from business or profession. The recent decision in the case of Mupala Bhaskar Reddy by the Bangalore Tribunal, which is my own case, which was rendered on 4th April 2022, has also supported my analogy that this landowner's share of sale of apartments or units cannot be taken as adventure in the nature of trade. So I think I've already reached 5:19, and I'm yet to get into revenue sharing. So what do I do, Nitish Moreji? Can I carry on, or because Mr. Gadia is waiting for his session also? Hello, Niteshji.
Sir. Gadia is waiting, sir. Mr. Gadia is waiting.
So what do I do? Should I complete this? I mean,
We can conclude
I leave it to you, sir.
7 minutes, then he can start, sir.
What, sir?
We have to conclude. If you can conclude, sir, little early, it is better, sir.
You give me the time, I'll conclude it accordingly.
Sir, that is better, sir.
No, give me the time. How many minutes more do I have?
5 to 7 minutes will do, sir.
Okay, thank you. I'll carry on. Now, when it comes to an area sharing development agreement, we have to understand that there are certain terms which are going to be used, such as gross receipts, gross revenue, distributable revenue, pass-through charges, etc. Now, in a revenue sharing arrangement, most important point is that there is no owner share and developer share. So the concept of saying that there is a transfer of owner share of land in favor of the developer, or developer constructing for and on behalf of the owner share does not arise. The owner, if you look at the arrangement very carefully, and that's how you need to document the revenue sharing agreement, you have to clearly document that the revenue share which is being received by a landowner is in essence for the sale or transfer of his undivided share of right, title and interest in the entire land. And the revenue share which is being given to a developer is in essence for transfer of his right, title and interest in the building being constructed by him. So we have to go into the concept of dual ownership when we do a documentation for revenue sharing arrangement, wherein the land is owned by me, the building is constructed by the developer, the insurable interest of the building is with the developer during construction period. Therefore, as far as we are concerned, there's a dual ownership. What developer is getting as revenue share is nothing but, in essence, for transfer of the building. What the landowner is getting as his share is in essence for sale of the land. Even for the GST purposes, which Manish Gadia will delve upon, it's very important that this language has to come in a revenue sharing arrangement. This will then successfully allow you to postpone the tax of the landowner and ensure that the landowner pays tax on the revenue share which he derives only at the point when the risks and rewards of ownership are transferred to the ultimate buyers using the provisions of Section 145(2) read with ICDS 4, read with Accounting Standard 9. I repeat, using these wordings in a development agreement and making the nature of transaction very clear cut, that what I'm selling is land and what the builder is actually transferring is the building. You can postpone your tax of the revenue share of the landowner till the date when the risks and rewards of land are transferred to the end buyers, either by handing over possession or by giving or executing the conveyance in their favor, right? By looking at by taking support from the ICDS 4 read with Section 145(2) read with AS 9 of the accounting standards issued by the ICAI. The department will definitely contend that you need to pay tax as and when you receive your revenue share, but we can successfully contend that we will pay our taxes only at the point of transferring risks and rewards of ownership. Now, in a development agreement of the revenue sharing in nature, there are a few clauses which are very, very important. We need to ensure that there's a price parity clause because the entire pricing is to be decided only by the developer. Therefore, a minimum price has to be mentioned in the development agreement below which the developer cannot sell. And further in the development agreement, there should be one more clause to state that both the landowner and the developer should meet periodically and decide the price for every quarter or every half yearly, as the case may be. Next, that we have to make it very clear that the developer will continue to be responsible under RERA for all construction related activities, and the landowner will be responsible for the title only. Next, we can also contend that the only Only disadvantage with the revenue sharing arrangement is that we have no control over the project, because the developer delays in handing over a possession of our share. In a area sharing, we used to have the general power of attorney in a restricted way to not allow him to sell his share till he hands over my area to me. Whereas in a revenue share, we don't have control over the developer. If he delays, because there's no area share, I mean, there's no landowner share, developer share. So even if he delays, the only recourse for the landowner is to enforce specific performance and to claim compensation for delay in delivery of the revenue share, which has to come to him. But he cannot, unfortunately, have any other hold over the developer. So revenue share, you have to enter only with reputed developers who have got a track record of completing their projects in time. So now section 50D doesn't apply to a revenue sharing arrangement, as I repeat, because there's no landowner share and no developer share. Then as far as the tax deducted at source is concerned, in a revenue sharing arrangement, please ensure that the buyers are going to deduct tax in the PAN number of the landowner as far as his share is concerned, and in the PAN number of the developer as far as share is concerned. It's a wrong practice being followed, that the developer is taking the TDS in his name only, and then he is doing TDS on the landowner while he's transferring the landowner's revenue share. That's a completely wrong practice. It is to be very clear that the end buyer has to deduct TDS in two different PAN numbers based on the revenue share of the landowner and the developer. Only then the provisions of section 199 of the Income Tax Act, read with Rule 37BA, which is the matching principle of declaring revenue, will be adhered to by the landowner. So, with this, I think, and the time given to me, I would conclude this presentation, once again thanking the organizers for giving me this opportunity on a Thursday afternoon to share a bit of my thoughts on this very contentious subject. Since I have a lot of things to share more and I'm unable to share it, I will be sharing this entire presentation with Mr. Nitish More, and he in turn can give it to the organizers for them to distribute it to all the participants in today's webinar. Thank you, ladies and gentlemen, for a patient hearing.
Sir, will you be able to share the draft agreement?
So draft agreement is going to be, obviously, that is one is confidentiality. Second thing is that I cannot give a standard template for all cases. That there are certain clauses I can share which has to be standard.
Which clauses we should include in the draft agreement? I do not need word by word, so that nothing is missed for the new persons who have just joined the CA fraternity.
No problem. I'll share some of the important clauses which I draft.
If you can give the points which we should include in the agreement.
I will share some critical clauses with all of you. It will be useful for all of you to ensure that it's part of every development agreement which you are part of drafting, as the case may be.
Yes, sir. It was a nice deliberation, sir. People are appreciating a lot. Actually, the time is too little to cover such a vast subject, sir.
I understand. As I told you, I've taken 4 hours on the same subject earlier.
So we have some questions also in the chat box. Also, if there is anyone who would like to ask any question to sir, I have Rajkumar ji raising his hand for a question. Sir, you can unmute and you can ask the question, sir. Rajkumar ji, please unmute and please. So there is one more question in the chat box. I will just read it out.
Can I ask one question?
Oh, okay, sir. Sir, please go on, sir.
Sir, in the agreement, if the price is determined that 3,200 rupees per square foot area constructed for the owner, that is sufficient. That is the value we can say, take it as the cost of the construction.
Okay, now in this regard, I can only tell you that you can take support from the decision of Kivaraj Motors, Ved Prakash Rakra, and latest decision in Sarojini M. Kushe's case of Karnataka High Court, where they held that if the construction cost is mentioned in the development agreement between the landowner and the developer, such construction cost can be taken as the deemed value of consideration.
Thank you. That's why, sir. Because you know the case we have replaced that one and it's accepted. by the
Nothing to worry, sir. I will share my mail ID with you. You address me, and I will tell you what you can depend on.
Thank you. Thank you. Thank you.
One sec.
So there is one more question in the chat box from BK
Beautiful
Bansal sir.
presentation, nice deliberation. Okay. Carry on, please.
People are appreciating a lot, sir.
Unfortunately, no time, sir. That's the whole problem.
Next time we have to take, sir, higher time from you, sir. Longer period, sir. Any more question?
Yeah, please. Anybody can come up with your questions, please.
Yes, sir. I would like to ask a question.
Yes, Mr. Bansal.
Sir, for calculation of full value of sales consideration under Section 50D, in case of a partnership firm, the development agreement was entered in October 2021. It is a area sharing model. Now, for full value of sales consideration, should I consider the fair market value only on the land because the area is unknown to us until
You're
we get the
absolutely
sale?
correct, sir. I repeat, Section 50D was introduced for this purpose only in 1/4/2012, which starts with the wording that where there's a transfer of a capital asset where the consideration is not determinate or known. The section starts with that wording itself. So we have interpreted that the Section 50D will squarely apply to a development agreement, area sharing type of a transaction. And as I repeated to you, even though 45(5)(a) came in 1/4/2017, as far as the firm, a company or LLP is concerned, and as long as they have held that particular asset as a capital asset in their books, they can continue to adopt 50D for determining their deemed value of consideration by offering the guideline value of land as on date of the development agreement for the purpose of getting taxed under capital gain.
Okay, so we'll have to get a report from the registered valuer regarding the FMV of the.
You can do that, or you can go for guideline value itself.
Okay, and sir, how will we get the value as per 2001 if the asset is purchased in the year 1970? How can we get the valuation?
Very simple, sir. You have to go to your in every city or every town. You have got this the registered values as per the under the registration manual with the respective stamp valuation authorities.
Okay.
So you need to go into that manual and then look at your survey number or your location, and then you will get the guideline value very clearly. But you have to get the manual for the year 2001.
Okay. Sir, my last question is that in case of revenue sharing model, where there is consideration being paid by the developer to the landowner over the period of 3-4 years. Say for example, first year they have paid 1 CR, second year they have paid 2 CR. So how will I file the ITR, because the sales consideration is received every year? So is it a case of relinquishment of title?
Mr. Bansal, right?
Yeah.
Mr. Bansal, as I repeated, I think I missed the last part of my session, or even I don't know. I am very clear about my thought process on this matter. The revenue share, not consideration. Please change the terminology. The revenue share which is given to a landowner by virtue of the development agreement will be taxed only in the year when the risks and rewards of ownership of such land is transferred in favor of the ultimate buyers of units or apartments in the project. Till such time, it will be shown as an advance. The TDS deducted will be shown as a receivable. The TDS can be carried forward under the new ITR, and the entire TDS can be claimed only in the year in which you offer it for tax. That is in the year in which risks and rewards of ownership are transferred by the landowner.
Okay, sir, understood. But sir, for in case of lump sum consideration, it will be taxed in the same year of receipt, correct?
Sir, it's not the consideration or the timing which is important. The taxable event is important.
Okay.
As long as you have not transferred a risk and rewards of ownership of the land, It has no taxable event.
Okay. Thank you so much, sir.
So anybody else, or can we conclude and Mr. Gadia can take over?
If there's any other question, I would like from the attendees. Yes, sir, please.
हेलो सर, एक क्वेश्चन है हमारा.
Yes, yes, ma'am.
बोलिए मैडम, आपका नाम बताइए प्लीज.
सर सीमा पगारिया.
सीमा पगारिया, ओके.
हाँ सर, हमारा एग्रीमेंट एरिया शेयरिंग एग्रीमेंट है एंड लैंड वाज एक्वायर्ड.
क्वेश्चन है मैम, लास्ट क्वेश्चन उसके बाद.
हाँ ओके नो क्वेश्चन, नो इश्यू सर. सर एरिया शेयरिंग एग्रीमेंट है, 50-50% एरिया शेयर करने का था. एंड जब हम लोग कैपिटल गेन कैलकुलेट करेंगे तो लैंड की कॉस्ट 50% लेंगे या होल लैंड की लेंगे?
Obviously 50% का ही लेंगे. मैडम आपको there are two incidents of tax as far as you are concerned. If you are the landowner, first is you have to compute capital gains on the 50% of land which you have given to the developers nominees, right?
Okay.
The second point of tax is when you get your share of units and you resell those, and when you sell those units with the 50% of land which you always retained by you, right?
Okay.
So there are two stages of tax. One is you pay tax on 50% of the land which is being given to the developer share. The other is you pay tax on your land which is retained by you and the building which has been constructed on your share as and when you sell it to an outside buyer.
Okay, sir. Okay.
Yes.
Okay, got it. Okay, thank you, sir.
Welcome.
Thank you, sir. Now we will conclude the first session, sir.
I request Girdhari ji to offer a formal vote of thanks to Ashok Raghavan sir.
Thanks, Ashok Raghavan sir, for sparing time and to give such a beautiful knowledge with the integrity of the how to prepare the agreement and how to handle the tax liabilities in both the cases, developer as well as the landowner. I think the members who has attended are greatly benefited, and we are looking forward for more seminars from your side, sir. Thank you once again, sir.
Thank you, Girdhar Lal Sharma ji and Nitish More and the rest of the team for this opportunity once again to be with Views Exchange.
Thank you, sir.
Thank you.
Now I request Manish Kadia ji to take over the session and enrich us with his deliberations.
Thank you. Good evening, good evening to everyone. And it was really a fantastic session, Raghavan sir. And it seems that after your session, it will be difficult for me to explain the provisions, but really fantastic. And I thank View Express Study Circle, especially Sharma ji and Nitesh More ji for giving me this opportunity to interact with all of you. So as Raghavan sir has already said that this is the topic on real estate, whether it is GST, whether it is income tax or whatever. If you have a whole day session or 2 day session, then also it is a short time. But I will try my level best to cover whatever best we can cover in 1.5 hours. So what we can do is that we have time up to 7, so maybe around 6:40 or so, we can stop the presentation and then take the question answer, because it is, I think, it is very important to take the questions, whatever maybe the participants having in their mind, to cover whatever maybe the presentation. So Sharma ji, is this okay? Sharma ji?
हाँ सर.
तो वैसा ही करें, कैसा आप बताइए?
हाँ सर, बोलिए सर.
कि घंटा भर प्रेजेंटेशन करते हैं और उसके बाद में लास्ट 15-20 मिनट क्वेश्चन आंसर करते हैं, जितना भी प्रेजेंटेशन होगा उतना कंप्लीट करके, instead of running entire presentation and not taking question answer.
क्वेश्चंस तो बेसी नहीं रहेंगे सर, 10 मिनट में हो जाएगा. 1 घंटा 15 मिनट अपने इसमें ले लें, 10 मिनट क्वेश्चन कर लेते हैं.
ठीक है, ओके सर, ओके. So GST on real estate, basically whether GST applicable, not applicable, how it will be applicable.
केस में भी आया ना सर, रिसेंट एक जजमेंट भी आया ना सर.
हाँ, वो भी मैं ले लूंगा सर, गुजरात हाई कोर्ट का जो जजमेंट है. Yeah, that I will cover. So what I have done is I have structured my presentation to cover the entire law, the scheme what government has framed on the basis of that, whatever they have issued the notification 4 and 3/2019. And I'm taking the Gujarat High Court judgment, which is saying that the value deduction toward value of land, which is optional, I will take it in the end. Because if I will take simultaneously, you will get confused, and because which are contradictory to the notification what has been issued by the government. So we presume that whatever the notification has been issued by the government, the entire scheme we will cover that as a correct, and then I will go ahead in my presentation, and in the last I will cover that judgment. So how this real estate will be taxed in GST, because the immovable property is neither service supply of service nor supply of goods. So what smartly government has done is that they have defined in Schedule 2 what is the goods or what is service. And in Schedule 2, in Para 2, they have said that activities activities which are treated as goods or service, and in Para 2 they said land and building, any lease, tenancy, easement, license to occupy land is a supply of service. Any lease or letting out of the building, including a commercial, industrial or residential complex for business or commerce, either wholly or partly, is a supply of service. So it's talking about the lease of land and lease of building. Both are covered as a service. Then in Para 5 of Schedule 2, it says that renting of immovable property is a service. Then construction of a complex building, civil structure or part thereof. Or part thereof, including a complex or building intended for sale to a buyer wholly or partly, except where the entire consideration has been received after the issuance of completion certificate, where required by the competent authority or after its first occupation, whichever is earlier. So in nutshell, what it's saying is that if you have received a single rupee or you entered into a contract for which is building which is under construction before the occupancy certificate or completion certificate has been issued by a competent authority, the entire amount will be taxable and GST shall be variable on the same. So maybe the property of 1 crore rupees, you have paid 70 lakh rupees till the completion certificate has been obtained by the builder, and balance 30 lakh you have paid to the builder maybe after a month or after 3 months of getting a completion certificate, then entire 1 crore will be liable for tax. And for the purpose of this clause, the competent authority means any government authority who is, I think somebody has unmuted his mic. I request all the participants till next 70 minutes or so, if they can keep them mic on mute. I request everyone to keep their mic on mute. The expression express competent authority means government or any authority to issue completion certificate under any law for the timing in force. Then architect registered under the Council of Architects, a chartered engineer registered, and a licensed surveyor, town authority. So these are the authority who can issue the completion certificate. Then next is, so before issuance of completion certificate, whatever you are getting is a supply of service under Schedule 3. If you are getting after issuance of certificate, completion certificate, it means you are entering into a contract or entire amount is received afterward. Then it is neither a supply of goods nor supply of service, and it is covered in Schedule 3. So this is very important. Again, work contract is also part of real estate, and work contract is defined as means a contract for building, construction, fabrication, completion, erection, installation, fitting out, improvement, modification, repair, maintenance, renovation, alteration or commissioning of any immovable property, whether in transfer of property in goods, is involved in the execution of contract. So basically the definition of work contract as far as GST is concerned is different than the definition of work contract which was given under the earlier erstwhile VAT law. In erstwhile VAT law, all the work contract where the property of goods is transferred, whether movable or immovable, both were taxable, but in GST only work contract means the immovable property wherein the transfer of property in goods is involved in the execution of such contract is considered as supply of service. Now the next question is, what is the time of supply as far as real estate are concerned? The general time of supply of service at the earliest of invoice, if invoice is required to be issued or if invoice is issued within 30 days, then the date of invoice or date of receipt of payment, whichever is earlier. And if invoice is not issued in 30 days, then date of completion of service or date of receipt of money, whichever is earlier, will be the time of supply. Again, the construction contract are a long-term contract, or lease of immovable property is a long-term contract. The general provision of time of supply will not apply, and specifically they have mentioned that it will be treated as continuous supply of service contract. Continuous supply of service has been defined as provided or agreed to be provided continuously or on a recurrent basis under a contract for a period exceeding 3 months with periodic payment obligation and as may be notified. So what is continuous supply of service? A service may be provided continuously or maybe on a recurrent basis. So basically, if you are giving any immovable property on rent, leasing out, then actually it is a continuous supply of service because you are giving on a recurrent basis. Or maybe a construction contract where a building will take maybe 2 years or 3 years to complete, maybe more than 3 months, then it will fall under continuous supply of service contract. As far as continuous supply of service contracts are concerned, what will be the time of supply? If the due date of payment is ascertainable by a contract, if yes, before or within time prescribed on which the payment is liable to be made. So take a leasing contract where it says that the rent for the month of May shall be payable on 1st May. Then actually you receive that money on 1st May or not. The time of supply will be 1st May itself because the payment is ascertainable. And if the due date of payment is not ascertainable, before or within the time prescribed on which the payment is received. In continuous supply of contract, there may be another possibility where the payment is linked to the completion of an event. In that case, before or within the time prescribed of completion of event. To take an example, you book the flat with a builder, with a developer, where he says that you need to pay 10% at the time of booking and 5% at the time of each slab. Once the slab will be put or completed, the 5% amount become due, whether you actually make the payment to the developer or not. But developer is accordingly liable to pay the GST according to that date. So I hope you are clear with the time of supply as far as the continuous supply of service contracts are concerned. So this is with the help of example, you can see that on stage 0, suppose you are liable to pay 20 lakhs. Due date is 15 July. Even if you are making payment on 15th August, but the due date is 15 July, you are liable to pay GST on 15 July. It is 15 July ka 20th August due date. Stage 1, completion of 5 floors. Suppose you are liable to pay 50 lakhs and that has been completed 5th floor on 20th September, 30th September. So the due date for September will be 20th October. Even if builder has received money in the month of November or maybe in the month of December, but as far as GST is concerned on this 50 lakh, he is liable to pay GST on 20th October or the due date or the date on which he is filing the return, whichever is earlier. So this is the system. Now, value of supply, taxes levied other than GST, if charged separately, that should be included in the value of cost. Next is important is interest or late fees or penalty for delayed payment of any consideration for any supply. On that also, GST is payable. So generally, stamp duty is sometime paid by the builder and charged to the buyer separately. So on that, whether developer is liable to pay GST, you can write your answer in a chat box. Since this is a study circle and I want prefer to have an interactive session instead of one-way presentation, so you can give your views that stamp duty on that also GST is liable to pay, builder has to pay. Yes, correct. Most of you have said no. So GST shall not be payable on stamp duty because the liability to pay stamp duty is on the buyer of the flat. And even if builder is charging, he is acting as a pure agent because it is not his liability to pay. So no GST will be leviable on the same. Next is steel or cement supplied to the construction contractor by the builder. So whether builder is liable to pay GST on the same? Yes or no? It's all depend on the contract. If the contract says work contract has been given to the work contractor, then even if that steel or cement is supplied by the builder to the contractor, he has to include the value of the same. But if it is a pure labor contract has been given and all material will be supplied by the developer, then this value of the steel or cement will not be included. So it's depend on the contract, how you enter into a contract. Another example is suppose the amount due is suppose 75 lakh, but the buyer has made a delay in the payment. And later on, builder has recovered 1,10,958 as a interest on this 75 lakh. So 75 lakh, the GST is payable when this 75 lakh become due. Maybe in our example, if you see this 75 lakh become due on 30th September. So he has to pay GST on 20th January, whether he has recovered or not. But this 1,10,000 rupees, once he actually receive money from the buyer, at that point of time, he is liable to pay the GST on this interest portion. Now coming to specific provision related to developers. So as far as sale of under construction flat or units are concerned, so earlier where service tax was 4.5%, VAT was 1% as far as the Maharashtra was concerned. GST with ITC was leviable from 1st July 2017 till 31st March 2019. The tax rate was 12% or 8%. And currently from 1st April 2019, it is 5% or 1% as the case may be. Joint development agreement, owner's area, GST with ITC 12% or 8% was leviable, or maybe work contract 18% on the contract. Now, owner's area may be exempt or RCM will be leviable. That we will see in the little bit later. Redevelopment of society, rehab flat given to the existing owner of the society. maybe exempt or RCM is leviable now. Earlier it was 18% GST. Sale of under construction commercial unit 12%, and still it is 12% with ITC as far as the commercial properties are concerned. Now we move to a new the scheme which was given from 1st April 2019 onwards. So commercial apartment, if it is a part of the residential project, in that area, if carpet area of commercial apartment is less than or equal to 15% of the total carpet area of the apartment. If yes, then it is a residential real estate project RREP. And if commercial area is more than 15%, then it will not be RREP, then it become REP. But carpet area, how to calculate and all that, they have given what is defined as carpet apartment. Residential apartment also they have defined shall mean an apartment intended for residential use as declared by RERA or to competent authority. So if it is declared as commercial, then it will not be a residential purpose, residential apartment. And commercial apartment shall mean an apartment other than residential apartment. So the definition of commercial apartment is very, very, very wide. It does not mean only the commercial property. Maybe a charitable hospital, construction of charitable hospital, a construction of a school, or maybe a college going to be run by a trust. All that will cover under the definition of commercial apartment and will be taxed accordingly. That's what we have to keep in mind. And if it is RREP, then effective GST rate. Everywhere I'm writing and in my entire presentation, I'm saying effective tax rate. But there, if you go to the legislation, there is no tax rate called 1% or 5%. Actually, it is 1.5% in case of affordable housing and 7.5% other than affordable housing. And then they have given 1/3 deduction toward value of land. So suppose the property is 3 crore rupees, you deduct 1/3 toward value of land, then your taxable value become 2 crore. And 2 crore if you charge 5% or 2 crore if you charge 7.5%, then the amount will come 7.5% on 3 crore. That's why I'm just giving the effective GST rate. But once you are preparing invoice, the tax rate will come 7.5% in your GSTR1. Return also, the builder has to show 7.5% and the taxable value not 3 crore rupees, taxable value 2 crore rupees. So RREP tax rate will be 1% or 5% as the case may be. And in case of real estate project, effective GST rate for commercial will be 12% and effective GST rate for residential, it will be 1 or 5%. So commercial, again, it will be tax rate is 18%, 1/3 deduction toward value of land is available. That's why it is coming 12%. And if there is a stand-alone commercial apartment, then GST rates, effective GST rate shall be 12%. And this is very important. I have already explained this. Then there may be possibility that on 1/4/2019, any project entered on or after 1/4/2019 will definitely go in the new scheme, and there may be a possibility of ongoing project also. First, we will see what is the new project. In case of new project, if the carpet area is equal to or less than 60 square meter in metro city or 90 square meter in non-metro city, and if the value is up to rupees 45 lakh, then it will cover under affordable housing, and effective GST rate shall be 1%, that is 1.5% on gross value. And if it is not then, if it is more than 60 square meter, then effective GST rate is 5%. Even if that carpet area is less than 60 square meter in metro cities, but the value is more than 45 lakh, then also GST rate applicable shall be 5%. And metro city carpet area means as per RERA carpet, and RERA include all your inner wall also into the calculation of carpet area. And metro city include Bangalore, Chennai, Delhi, Hyderabad, Kolkata, and Mumbai. For the purpose of calculating value, the gross amount shall be sum total of consideration charged for flat, amount charged for transfer of land or undivided share of land, as the case may be, including by way of lease or sublease, any amount charged by the promoter from the buyer of the apartment, including preferential location, development charges, parking charges, common facility charges, etc. So everything, whatever consideration has been charged, will be included in to calculate that 45 lakh limit. But it will not include stamp duty, maintenance or deposit for maintenance, and maintenance for common area. So many times builders are charging this. They are required to maintain in various cities. They are required to maintain till the society is formed. That property, for that they are charging maintenance. But that 45 lakh, this will not be included. And promoter means as per RERA. Again, carpet area, promoter, etc. has been defined. I am not going into this. I will share the presentation to the study circle and they will share to you later on. Now again, we are going to what is ongoing project. First, we will see what is ongoing project. If the commencement certificate has not been issued by the competent authority till 31st March 2019, then where the commencement certificate in respect of project is not required to be issued by the competent authority, then the certificate in the clause issued by maybe the architect, chartered engineer or licensed surveyor. Further, it says that completion certificate has not been issued or first occupation of the project has not been taken place on or before 31st March 2019. Then apartment being constructed under project has been partly or wholly booked on or before 31st March. So in case of ongoing project, the apartment should be booked. An explanation has been given for the purpose of clause A and B above. The construction of a project shall be considered to have been started on or before 31st March if the earthwork for site preparation for the project has been completed and excavation for foundation has started. So not the IOD. If you have received IOD, then also it will not be treated as ongoing project. The land work should be completed and the excavation for foundation should start on or before 31st March 2019. Then only it will qualify as ongoing project. Commencement certificate, competent authority, we have already said. The one condition is that apartment should be booked on or before 31st March 2019. Again, it has been defined in the notification saying that part of supply of construction of which has time of supply on or before 31st March 2019. It means that the sum amount should be due on or before 31st March 2019 of that flat. At least one installment has been credited to bank account of the registered person on or before 31st March 2019. So it may be possible that person may book the flat on 30th March 2019, but the amount is not been credited, even if the check has been given to the developer, but amount has not been credited to his bank before 31st March, then also it will not be treated as apartment has been booked. An allotment letter or sale agreement or any other similar document of booking has been issued on or before 31st March 2019. So all these three conditions should be satisfied for this. And in case of redevelopment of property, it is deemed to be satisfied. So what happens in case of redevelopment? Builder will not receive any money from the existing owners, but in the form of development right, he has received money in kind or consideration in kind That's why they have said that if the installment has not been received, then also the flat will be treated as book as far as the ongoing projects are concerned. In case of ongoing project, option has been given to the promoter and he can opt for the old GST rate. And old GST rate was, in case of low cost housing, it was 8%. In case of others or including commercial property, effective tax rate will be 12%, and they can continue to do that, and they can take the input tax credit also. And they have the option to go for new scheme also, that is 1% or 5%. So there may be two possibilities, that construction and booking has started on or before 1st April 2019, that is in the case of ongoing project. The project, suppose eligible for GST at the rate of 8% up to 31st March 2019, that is low cost housing. The affordable housing, that word they have given from 1st April 2019, but before that they were saying low cost housing. And low cost housing, they were saying that up to area up to 60 square meter. And there was no cap of value up to rupees 45. So in that scenario, if they were paying GST up to 8%, then if they are going in the new scheme, then they can pay GST at the rate of 1%. So even if the value of the flat maybe 60 lakh, maybe 70 lakh, but it is an ongoing project and the flat has been booked on or before 1st April 2019, then for 60 lakh, 70 lakh, 80 lakh value also, if it is less than 60 square meter, he can take the benefit of GST at the rate of 1%. And if project is not eligible for 8%, definitely it will be 5%. And construction is not started, then it will be 12%. An option to be exercised by 20th May 2019. If not exercised, then it is deemed that the builder is going for the new scheme only. It is forced to go in new scheme, but if you want to continue in the old scheme, you have to go for and opt for this scheme. And all GST and the new scheme has to be paid in cash. ITC cannot be utilized for the payment of the same. And in case of work contract service, commercial apartment, GST will be a work contractor need to pay at 18%. In case of residential, again, if it is affordable or other than affordable. Others also it is 18%. In case of affordable housing, if carpet area of affordable is less than 50, more than 50% of the total carpet area, then the work contractor need to pay GST at the rate of 12%. Otherwise, he need to pay GST at the rate of 18%. So if you go to the definition of affordable, it says that the carpet area should be less than 60 square meter and the value shall be 45 lakh. Less than 45 lakh, up to 45 lakh. Now as a work contractor, I will come to know that builder has sold this property up to 45 lakh or maybe more than 45 lakh. So for giving this, they have said that in case the project has 60% affordable and 40% non-affordable, in that scenario, work contractor has to charge GST at the rate of 12%. And later on, if builder has actually sold the property, 55% of the property he has sold more than 45 lakh, then the differential GST of 12%, that's 6%, builder has to pay under reverse charge. So contractor need not worry that whether it is affordable, whether it is not affordable. He can take the letter from the developer that the affordable 50% or more carpet area shall be the affordable housing. Then as I said that the exemption has been granted in respect of development right, TDR, FSI, etc. given by the owner or maybe the society in case of redevelopment to the developer. So it is exempt. An exemption granted in respect of development right and leasehold premium upfront only. That is lease period of 30 years or more. Used for construction of residential property liable to GST, and no such exemption has been given in respect of commercial property. Exemption to apply for transfer of development right pursuant to joint development agreement, where the area share or maybe the revenue share for residential complex for sale allotted to the landowner. Development right, TDR, FSI, leasehold land used for following will still be liable for 18%, that is construction of commercial premises, construction of factory, corporate, mall, commercial complex or letting out or own use, and of residential complex intended for sale after completion. In case of JDA, redevelopment agreement, transfer of development right by landowner society is exempt, but rehab construction services provided by developer to the landowner society SRA will still be liable at 12% or 18%. In GDA, owner purchase TDR liable to pay GST on the same. His output is either exempt or developer will pay under RCM. There will be a double taxation. Further, in case of JDA or redevelopment of society, the time of supply shall be at the time of completion certificate or first occupation, whichever is earlier. So basically, so whatever constructed property builder developer is giving to the landowner or maybe to the society, at the time of possession, he has to pay GST, not at the time of getting the development right. And the value of supply shall be on the value of total amount charged for similar apartment in the project to independent buyer nearest to the date of transfer of development right. So basically, if the development right has been entered in the month of May 19, building has been completed in the May 22, GST shall be leviable on the constructed property given to landowner in May 22, but maybe in the month of June 19 or maybe in the month of July 19, whatever the first flat has been booked by a builder to an independent buyer, so that rate will be applicable and GST will be payable now. To understand this, landowner promoter transfer TDR FSI, additional FSI to the developer promoter, and developer give the constructed apartment to the landowner. This is the both are giving providing service to each other. So developer promoter is liable to pay GST whatever constructed property, this service, whatever he is giving to the landowner promoter. So it may be possible that project may be of 100 flat, 50 flat, maybe landowner will get, and developer promoter will sell 50 flats of his own. So developer promoter will charge GST to the landowner promoter, and landowner promoter in turn will not keep that 50% for his own consumption. Definitely he is going to sell to the buyer in the open market also. So he also sell. So he is also a promoter as far as the RERA is concerned. We have seen the definition of promoter. So he is also liable to pay GST whatever he is selling property to this buyer. And if he is in the new scheme, the scheme categorically said that ITC is not available, entire amount need to be paid in cash. Second, as we discussed, the construction started in the month of May 19. Building has been completed in May 22. His developer will pay GST on his portion, that is landowner portion, in the May 22. But landowner may start selling the property between May 19 till May 22. Then only he is liable to pay GST. Whatever property landowner will sell after May 22, definitely it is after completion certificate, he is not liable to pay any GST on the same. So even if you want to take the GST, even if you want to take ITC, then also since he has not received the invoice, ITC invoice is not there, his supplier has not paid the ITC, he will not get any ITC. So that is again a big challenge as far as this entire scheme is concerned. This already discussed. So again, it may be possible that the landowner promoter will end up paying a double taxation. But again, if you are going into the area sharing, instead of, not area sharing, if you are going into the revenue sharing, then in my view, double taxation will not apply. The buyer will pay 50% to the developer, 50% to the owner. And in that scenario, owner will pay on 50% of his share and developer will pay 50% of his share. GST and double taxation can be avoided. So this is the another way of looking at how you entered into a joint development agreement. Again, there is a developer and there is an owner and they have entered into a 100 flat property. Developer has given 40 flats to the landowner. He has sold 30 flats till the occupancy certificate or completion certificate has been got, and 30 flat remains unsold. And value of each flat is suppose 1 crore rupees. So as we discussed here, owner is also providing a service to the developer of that is transfer of TDR, FSI or additional FSI or maybe the lease, long-term lease. So that will also be taxable. But as I said, some exemption has been given. Now we are on to that exemption. So 40 flat has been sold by the developer to the owner, 30 flat has been sold to the buyer. So 30 flats are unsold. So the development right GST shall be leviable only on the unsold portion, because this 40 flat which has been given to the owner promoter will also be treated as sold. So he has to pay GST only on 30. But how much flat has been sold by the developer, owner will not come to know at any point of time. So what they have said is that the developer will only pay the GST on this 30 unsold flat under reverse charge mechanism for the transfer of TDR, FSI or additional FSI, long-term lease premium, whatever as the case may be. And how it has to be calculated is that whatever may be the first flat has been sold by the owner, by the developer to the third party, the GST on this 30 unsold flat shall be payable at the time of first possession or at the time of completion certificate. He has to pay GST. So nutshell, and at the rate of 5% or 1% as the case may be. So in nutshell, basically, whether the developer will sell the flat under the new scheme, then he will, if he has sold the flat, he will recover GST from the buyer and pay. If he has not sold the flat, but he is doing a joint development agreement or he is doing a redevelopment of the society, in both the scenario, he has to pay GST on this unsold flat, and from his own pocket, the GST rate will be 1% or 5%. Only that the first flat what he has sold or that value he has to pay at the time of possession. So it is advisable that if possible entire flat should be sold, because we have seen at least in Mumbai that many developers are saying that we will not sell the flat because GST is leviable and afterward it is not. But this is not the case under new scenario in case of joint development. So this revenue share already I have discussed. Area share I have already discussed. Again, builder shall be liable to maintain project-wise account of inward supplies from registered and unregistered supplier and calculate tax payment accordingly. And builder shall submit the above detail in the prescribed form electronically on common portal by end of the quarter following the financial year. The tax liability of shortfall and inward supplies. So basically, whatever builder is buying project-wise, he has to maintain. And under RCM also from unregistered person, he has to pay GST. So basically, this we will see here how it works. It is easier to understand. Suppose he has purchased, total cost is 100 rupees. 30 rupees worth of material of the project he has purchased from registered taxable person on which he has paid GST to the supplier. He has purchased 25%, 25 rupees worth of goods from unregistered supplier on which they have not charged any GST. 20 rupees at 8 and 12 is of cement. Out of that cement, 12 rupees he has purchased from registered dealer and 8 rupees cement he has purchased from unregistered dealer. 23 rupees is the cost of his TDR, FSI, long-term lease, etc. And 2 rupees is electricity, HSD, motor spirit, natural gas, whatever is required for the project. So, this 23 and 2 will not be calculated for the purpose of calculating reverse charge mechanism, how he has to pay the, how builder has to pay. So actually the cost may be 100 rupees, but for the purpose of calculating reverse charge, the cost becomes this 75 rupees. That cement and other this purchase. The total cost for the purpose of calculating reverse charge, it is not 100, 75 we have to consider. The cement portion, cement is liable for GST at the rate of 28%. So GST on the cement he has to pay on monthly basis. So whatever cement he is purchasing from unregistered supplier, he has to pay month on month basis under reverse charge mechanism. As far as this 25 rupees is concerned, so law says that if more than 20% whatever he is buying from unregistered person, so 20 rupees of that 75% what we are talking about, because this 23 and 2 we have to reduce. So now the cost become my 75 rupees. Out of the 75 rupees, 25 rupees is my unregistered purchase, and this 75 ka 15 rupees, that is 20% of the 75 rupees I can purchase, I am allowed to purchase from unregistered person, and I need not pay any amount under reverse charge mechanism. To balance 10 rupees of this, I have to pay under reverse charge mechanism, and 18% I have to pay GST irrespective of the value of the or GST rate applicable on the good. Maybe I purchase a good maybe worth rupees 5 on which GST is leviable at 5%. But in this scenario, it will be 18%. Even if I am purchasing 28% wala item, then also I have to pay at 18% under reverse charge mechanism. It may be possible that GTA, I have required to pay GST at the rate of 5% on every month basis, whatever GTA service I am receiving. So even if GTA is unregistered, for the purpose of calculating this 20% limit, it will be treated as registered person only. And salary should not be considered for calculating this 100 rupees calculation what we have said. And this unregistered purchase 25 rupees will also include any exempted item purchase. So in nutshell, if I am purchasing any exempted item on which also I require to pay GST at the rate of 18% under reverse charge mechanism, subject to that exemption of 20% value. See another scenario that 23 and 5, the 75 rupees actually again, but in 75 rupees, only 5 rupees is my unregistered purchase. So it is less than my 20 rupees, 20%. So nothing to be paid under RCM. And in case of commercial property more than 15%, then they are liable to pay GST at the rate of 12% and they can take ITC. So this RCM of 20% will not be applicable for the purpose of commercial property. This is only for residential property on which ITC is not available. Now, how ITC if builder is doing a commercial construction or maybe in the ongoing project. So how the ITC shall be reversed in this kind of scenario. On or before issuance of completion certificate, it will be treated as supply as per Schedule 2. After issuance of completion certificate, neither supply of service nor supply of goods under Schedule 3. So Rule 42 says that you have to go as per the turnover. So suppose the project has been started in the year 2018-19, and since it is an ongoing project or whatever, maybe a commercial project, so ITC of 50 lakh has been availed in the year 18-19. In the year 19-20, suppose ITC availed is 1 crore rupees and 10 flats are sold. In our example, all flats are sold at the same price. So 10 flats are sold and consideration received is 15 crore. GST applicable, yes. So 0.3 crore after utilization, GST paid for 0.3 crore after utilization of ITC. So I will avail 1 crore plus 50 lakhs both. 1.5 crore I will avail. 1.8 crore is my liability. So 0.3 crore I will pay. 2021, 5.5 crore ITC utilized, 20 flats has been sold on which 55 crore has been received as consideration. So I will pay 1 crore after utilizing ITC. 21-22, 11.5 crore, 10 flat further sold. Money received is 85 crore of this 40 flats. So 10.2 crore by utilizing ITC and balance ITC of 1.3 crore carry forward because the ITC is more here than my liability. And 22-23, I received the completion certificate, and after completion certificate, I have sold 10 flats out of 50 flats. And the value of each flat is 8 crore rupees in our example. So total 165 crore I have received. Out of that 85 lakh is my taxable income and 80 crore is my exempt income. Total number of flat is 50. So now question is, what about ITC? Balance of 1.3 crore availed in current year and 2.5 crore, total 3.8 crore ITC, whether I can avail or not, and how to be reversal to be made. So again, I have three options. If I go as per turnover, what has been given in Rule 42, for all the other items than the construction, it says that total credit is 2.5 crore. Taxable turnover is 85 crore and exempt turnover is 80 crore. If I apply the ratio, then I need to reverse 1.21 crore, and whatever credit I availed in the previous year, 100% credit I can take. There is no restriction as such. Another option is, if I go as per area, then the total credit whatever I availed of the project is 20 crore. Area of all the flat is same. So sold before OC is 40 and sold after OC is 10. So 80% area is sold and 20% area is unsold. So in that scenario, I need to reverse 4 crore. So 3.8 crore I have in my credit ledger and 20 lakh I have to pay from my cash ledger and reverse this 4 crore as my area. Another option is I go as per total value. So total credit is 20 crore. Total taxable sale is 240 crore. Total non-taxable sale is 80 crore. If I go into the ratio, then I need to reverse 5 crore. So I request participants, if you can throw as per your view, in this scenario, I need to reverse 1.21 crore, 4 crore or 5 crore. Mantri ji has said 4 crore, Sandeep Agrawal ji 4 crore. So it will be as per area because rule 42 has been amended and now it said that not as per turnover as far as the developers are concerned, it has to be as per area. So now 4 crore need to be reversed to 3.8 crore from the credit ledger and balance 20 lakh from the cash ledger need to be paid by the developer at the time of completion of project. Now I have written some issues that we will discuss. What is the significance of term one-time option? Whether option once exercised, does it become irrevocable? Can one amend option selected invariably? Because you have seen that in case of ongoing project, they have said that one-time option has been given to the developer to opt. And if he has opted for the old scheme, then it cannot be reversed. So that's what we have to keep in mind. Again, whether the option is to be exercised by unit, financial year, project wise, or entity wise. So I can go one flat with old scheme, another flat in the same wing with the new scheme, or every financial year I can change, or maybe a project wise, or maybe entity wise. Suppose I have 4 different companies and in each company there are 3 different projects. So in company A, I have to opt for all the ongoing scheme or maybe the new scheme for all the project or this. So what is your view? So you can write unit wise, financial year wise, project wise or entity wise. So Diptaji Pal has said project wise. So many of you have said project wise. Absolutely, you can choose project wise. So you can't change financial year wise or entity also. In one entity, if you are having 3 different projects, so you can choose any of the options depending on the project. Whether different option can be exercised in respect of different building in the same plan layout. Of course, yes, subject to the condition that as per RERA, if it is treated as 2 different projects within the same layout. In Bombay, in major complex, maybe 2 acre, 3 acre, or maybe 1 acre land, this projects are going on. So they are taking different registration under RERA for different buildings. So there they can opt. Whether one can exercise different option in respect of flat sold before 31st March 2019 and flat to be sold thereafter, no. Because once you have opted for the new scheme, then entire whatever old flat also you have sold, the balance payment you have to pay under the new scheme only. Builder was selling affordable house and charging 8% tax, effective tax till 31st March 2019 due to the cap of 45 lakh. The house in the project does not fall under the definition of affordable residential apartment on or after 1st March 19. Builder intend to opt for old scheme of the taxation as there is a huge ITC accumulation for this project. What will be the applicable tax rate in such case? So of course, it will be 8% only. In case builder does not opt for old scheme, what will be the tax rate applicable to erstwhile affordable housing? Now he is selling more than 45 lakh. So whether it is effective tax rate is 1% or 5%. Deepak Mohtaji has said 1%. I have already discussed this issue while discussing this in the beginning. It will be under 1% only. Another issue is we have seen that in the period of lockdown, then Corona started, so 3, 4, 5 months continuously offices were not opened up. And tenants have requested owner not to charge rent because they were not operational, and owner has waived off the rent maybe for 3 months, 4 months, 5 months. Whether owner is liable to pay GST on this rent, yes or no? Owner will be liable to pay GST? Rajendra Kumar Bhaiti ji has said yes. Most of you have said no. So what we have to understand that in case of a leasing contract, what service owner is supplying is giving a right to use the premises to the tenant. Suppose he has entered into a contract for a period of 5 years on 1st April 2019. So he has given a right to use that premises for next 5 years on 1st April 2019. So entire service has been supplied by the owner to the tenant on 1st April 2019. But this service is a continuous supply of service. So law says that you have an option, you are liable to pay GST when the amount will become due. So as per contract, every month, beginning of the month, the rent amount will become due. Because of that, you are paying the GST not on 1st April 2019, but you are paying on every month. As far as issuance of credit note is concerned, law says that either you have not supplied the service or service whatever you have supplied is substandard service. Then only you can issue the credit note. The premises during the lockdown period was under the possession of the tenant only. And you have not given any substandard service to the tenant. So in my view, GST shall be leviable on this kind of contract. Provided if your contract, what you have entered on 1st April 2019, have a clause that if you are not going to use or your office will remain closed maybe for more than 1 month, 2 months, 3 months, for any reason or for the purpose of the government reason, then I will not charge rent. In that scenario, only GST shall not be applicable, and in 99.99% cases, this kind of clauses was not there. So in my view, GST shall be applicable on this period. Another issue, there is a construction site. The contract is of rupees 2 crore. And 65% of the work is completed and invoice is raised 1.3 crore. Generally, what happened is developer give the contract to the work contractor, and he is required to issue the invoice on monthly basis, or maybe some work has been completed. So he will issue the invoice, contractor, then the architect or builder will certify, and then he will release the money. This is what generally the contracts are. And after also, suppose the work of 1 crore has been completed, then builder will retain certain 5%, 10% depending on the contract as retention money. And that retention money will be released once the project has been completed, or maybe after 2 years or 3 years after the project has been completed. So now work contract service is also a continuous supply of service contract. So suppose 65% of the work has been completed out of 2 crore contract. So invoice is issued by 1.3 crore. But 10 lakh rupees has been retained by the builder as a retention money as he has made the payment of 1.2 crore. So in this kind of scenario, work contractor will pay GST on 1.3 crore or he will pay GST on 1.2 crore. Yes, Deepak Mohtaji has said 1.3 crore. Yes, everyone is saying 1.3 crore. So he will pay GST on 1.3 crore. Builder either maybe in the, if it is a residential complex and under the new scheme, he is not going to get the credit. So this amount will go waste. Or again, even if builder is doing a construction of commercial property, GST law says that as per section 16(2), you will get the credit once you make the payment. If you are not making payment within 180 days, then you have to reverse the credit. So builder will take the credit of 1.3 crore. After 180 days, reverse 10 lakh rupees ka credit, and he will get the credit once he will release the retention money of this 10 lakhs to the developer, to the contractor. So builder effectively will not get the credit, and buyer contractor will liable to pay the GST. So what best you can do in this kind of scenario is, since this is a continuous supply of contract, law says that whatever amount is due, on that you are liable to pay GST. So if contract between work contractor and the developer will be made in such a fashion that whatever amount is certified and whatever amount is due, suppose 1.2 lakh, 1.2 crore only, so GST shall be leviable on 1.2 crore. Then the liquidity position can be improved and GST shall be leviable on 1.2 crore. Now again, it's a very good case law of Odisha High Court. In case of Safari Retreat Private Limited, it's very interesting case law. Here, the applicant is into the construction of a shopping mall, which is not going to sell any property, is going to give on lease after completion of this. Section 617(5)(c) read with D says that the contract of the ITC of work contract is block rate because you are going to capitalize the same and you are not into the supply of work contract service. Only in that scenario, credit is allowed. So the matter rose to the Odisha High Court, and very beautifully Odisha High Court has said that rent income is arising out of mall which are constructed after paying GST on different items. If ITC is denied on building mean that intended to be layout, it would amount to a treating the transaction as identical to building mean or intended to be sold. Once you go to the definition of supply also, the definition of supply says that include leasing, letting out, etc., licensing, etc. And further it says that it is violation of Article 14 of the Constitution, treating these two different types of transaction as one for the purpose of GST is contradictory to basic principle. So nutshell, the court says that ITC of the construction will be available for construction of a mall which is going to be leased out. The same ratio can be applied even for the hotel also. If somebody is constructing hotel, which is going to give on rent or maybe room rent, he is going to get. So in my view, credit will be available, but the matter is before the Supreme Court. So we have to wait and watch. But in my view, you should advise your client that you should take the credit, because once you have not taken the credit, then 16(4) will apply, even if Supreme Court will give. But definitely, if you are taking credit, you are inviting litigation. So you be ready for the litigation if you want to take the credit. Another important two different AR also I'm going to deal here is very important, whether sale of land or whether sale of construction. This. So we know that sale of land is not leviable to GST. So it is the developed rent. So there are two different judgments. One is Karnataka triple AR. Here the applicant entered into a joint development agreement with the landlord for development of land into residential layout along with the specification and amenities. So Mr. A entered into a contract with a developer who will develop the land. So maybe a sewerage system, maybe the drainage, maybe electricity, maybe the road, that what he will do on the road, on the plot itself, and that they will divide the plot and they will sell that property. So whenever the owner will sell that land after development, 75% will be retained by the landowner and 25% will be retained by the developer. But they are not constructing any property on that land. So the question is whether GST shall be leviable on the same. AR says that actually there is a contract between the owner and the developer. The developer is providing service to the owner, and owner only the payment mechanism is that once the land will sell, 25% will go to the developer. So the owner is getting 100%, is supposed to get 100%, and 25% he has to give, but directly now the builder, now the buyer is giving 25% to the developer and 75% to the owner. So this 25% shall be leviable to tax as a construction of roads, drainage, etc. is a work contract service. On that GST shall be leviable. So again I am repeating, here the fact is different. Here there is no tax on the sale of plotted land or developed land. Again, in case of Sri Dipesh Anil Kumar Naik, in case of Gujarat double AR, where the owner himself is required to develop the land and he has to construct sewerage and drainage line, water line, electricity line, land leveling, road for road, pipeline, facility, drinking water, street light, telephone line, etc. And then he is selling a plot to the buyer. Here the judgment has been given that the seller should charge GST is applicable on the sale of plotted land. In my personal view, this judgment is not a correct judgment because GST shall not be leviable on the plotted land. So this AR should be challenged. Now GL Sharma ji in the beginning has said me to cover the recent Gujarat High Court judgment. So as I said in the notification 3, notification 4, there is a deduction toward value of land, 1/3 deduction toward value of land is given. And it is mandatory as per law. So anything you can't make mandatory as per law, it has to be an optional. So here the issue was whether the 33% deduction toward value, compulsory deduction toward value of land is constitutional. It is held that ad hoc rent rate of 33% cannot be applied for ascertaining the value of land for calculating goods or service portion in the sale of under construction flat. More so when the actual value of land is available in the contract. Government cannot rewrite the contract which is already entered by the two independent parties and try to find out the value of supply when it is specifically provided in the contract. GST law has prescribed valuation rules which are comprehensive enough to take care of various situations where the taxable value cannot be determined from the transaction value. An ad hoc of 33% toward value of land should be given as an option and not as compulsion. Now, after this judgment, what next? So if you like city like Bombay, Kolkata, where the value of land is not 1/3, it may be a more than that. And in case of Bombay, the 75%, 80% is the value of land. So if you have in the agreement, if you specify that the value of land is this much and for construction, the value is this much. So it has to be there. The agreement shall be drafted very carefully. Deduction of 33% toward land is optional. Give a value of land and service separately in the contract. Balance value shall be work contract service, and ITC shall be available to the developer. So this is, so what is important is if you want to take the benefit, it has to be drafted very, very, very carefully, your agreement, and it should have an option. It should have the value of land also in the value of the contract itself. So this is from my side. Once again, I thank you Express Study Circle for giving me this opportunity, and thanks to all the participants for making this session interactive. So really enjoyed the session. Thank you very much.
Thank you so much, sir, for that enlightening session. Now I would invite the attendees for any question that they wish to ask from Manish, sir. Harshit ji, Deepak ji, if you have any question, you can unmute and please ask, sir.
I have one question regarding development agreement. One development agreement was executed in the revenue basis. Now the project is completed, and now some flats and shops are left. Some flats are left for the sale purpose. Now, hello, are you audible?
Yeah.
Sir, now the landowner and the developer, they have gone for the allocation agreement. Now, since the occupancy certificate has been received against the project, there is no liability of GST. So, what will be the GST portion on the landowner?
Your voice is not tracking, Harshit ji.
Sorry, sir.
Yeah. Now it is audible.
Yes, sir.
Yeah. So what I understood is you have entered into a joint development area agreement on the revenue on the area sharing, revenue sharing.
Revenue sharing, sir.
Revenue sharing model. So whatever flat will be sold, certain portion will landowner will retain and certain portion the developer will retain. Correct?
Right, sir.
Correct, Harshit ji? So now the construction has been completed, completion certificate has been obtained, and certain flats has been unsold.
Right, sir.
Correct. So whenever the flat will be sold after the completion certificate, GST shall not be leviable on the same, provided that property is not under, that developer is not under the new scheme. He is under the new scheme.
So he's under the old scheme, sir.
So if he is under the old scheme, so he is not liable to pay anything now.
No, sir. What will be the GST part on the land developer side? Will the landowner side? Will the developer will charge any GST to the landowner for giving?
No, landowner developer will not charge any GST to the landowner because they entered into a joint development and they are jointly providing service to the buyer of the flat, and whatever money they have received from the buyer of the flat, on that their portion they have already charged and paid the GST.
Right, sir, right.
There is no further GST liability. That's what we have discussed.
Okay. Thank you, sir.
Welcome. Deepak ji, now you can ask your question.
Good evening, sir. Thank you for a very enlightening session from your end. Sir, I have just a bit of confusion regarding this 80-20 ratio which they have come up for, the
RCM.
Yes, inputs from registered and unregistered. For the unregistered part, sir, my question would be like, if a company is, say, paying interest cost, bearing interest cost, or making commission payments for sale of some units of projects to unregistered parties, would that also be needed to be factored in this 80-20 ratio?
So whatever commission they are making, they are paying to the real estate agent for sale of that property, na?
Right. And
That-
they're also making out interest payments. Like, sir, commission is a later part which I'm thinking of right now. There is one of my clients who is still into construction, has not sold a single unit. They're just making, they're incurring costs out of interest, out of borrowed funds, and paying interest on that. So I'm worried about the interest part, like, because the interest, entire amount of interest from unregistered parties. So do we need to, consider that in the 80-20 ratio?
See, by way of FAQ, they have clear that in case of exempt supply, it will be treated as they have purchased from unregistered person, and accordingly you have to calculate that ratio. So by going by that FAQ, that interest portion also 18% GST will be applicable, but of course in case of interest, you have a good case to argue, but again it may lead to some litigation. If your client is ready, so it's a good case to argue.
So can we take an approach that interest is not a direct input in the project, and the entire framework is intended for the project costs and not the ancillary costs?
So that's what I'm saying. It's a good case to argue, but department may take you for litigation. So you should caution your client that there may be a possibility of litigation, and if your client is ready, so you should take a chance not to pay, and good case to argue definitely.
And sir, what is your view on the commission part?
The commission definitely you are will cover in calculating that, because input means does not mean only input, because your business expenditure, your marketing expenditure, everything will be covered. Na? Now the definition of ITC is very big.
Right, sir. Agreed.
Yeah. Sandeep ji? Sandeep Agrawal ji?
Yes, sir. हेलो
Yeah, Sandeep ji, tell me.
सर मेरा एक क्वेश्चन है, जैसे मेरा एक रेवेन्यू शेयरिंग एग्रीमेंट है, उसमें रेवेन्यू शेयरिंग एग्रीमेंट में डेवलपर ही 100% अमाउंट कलेक्ट कर रहा है, एंड रिमेनिंग 30 या 40% जो भी है वो लैंड ओनर को दे रहा है. तो जीएसटी आरसीएम लगेगा क्या, और फिर क्या वैल्यू हो सकती है उसमें?
नहीं, तो उसमें रेवेन्यू जैसे जैसे आता जाएगा तो ओनर को देते जाएगा ना, तो उसको कहीं ना कहीं एस्क्रो अकाउंट में या कहीं डालता होगा संदीप जी वो.
इसको मैं वो पूरा अपने अकाउंट में ही ले रहा अभी.
नहीं, अपने अकाउंट में लेता होगा, लेकिन उसका कुछ सेटलमेंट करते होंगे ना. तो मेरे हिसाब से तो इसने जो है बिल्डर ने 70% पे भरना चाहिए और 30% पे इसने भरना चाहिए एक्चुअली, बिकॉज ही इज कलेक्टिंग ऑन बिहाफ ऑफ ओनर ना 30 रुपीज.
आरसीएम का लायबिलिटी ऐसे आएगा नहीं, मतलब
नहीं, आरसीएम नहीं आएगा. मेरा व्यू इस पे आरसीएम नहीं आएगा इन केस ऑफ एरिया शेयरिंग, रेवेन्यू शेयरिंग, सॉरी. विकास जी.
तो मेरा सवाल मैंने चैट बॉक्स में लिख के दिया आपको. बेसिकली ये जो लीज होल्ड लैंड अभी आजकल रेलवेज प्रोवाइड कर रही है बिल्डर्स को पीरियड ऑफ 100 years. अब सवाल याद है कि उसके ऊपर में जीएसटी लगेगा कि नहीं.
मैंने ये एनालिसिस नहीं किया है विकास जी, लेकिन मैं फिर भी एक बार समझना चाहूंगा कि बिल्डर को 99 ईयर्स की 100 ईयर्स की लीज पे प्रॉपर्टी दे दी है रेलवेज ने,
राइट.
और वो फॉर द पर्पज ऑफ क्या है,
डेवलपमेंट करके डिजाइन डेवलप एंड यू कैन सबलीज इट. 100 years के बाद तो ये रिटर्न आ जाएगी रेलवे के पास में, तो ये बेसिकली सबलीज ही होगी.
नहीं, फॉर रेसिडेंशियल प्रॉपर्टी, कमर्शियल प्रॉपर्टी या क्या है?
प्रॉपर्टी.
So to my understanding, it is commercial in nature, sir.
हाँ,
Commercial in nature.
कमर्शियल है तो देखो उस पे 18% जीएसटी आ ही जाएगा. वन टाइम प्रीमियम है जो भी है उस पे आ जाएगा. और अगर वो रेसिडेंशियल पर्पज है, फॉर द पर्पज ऑफ रेसिडेंशियल यूज, so that exemption is there in notification 12/2017. So whether you can take the benefit of the same, so GST नहीं आएगा.
नहीं, मैं ये बोल रहा हूँ कि जब मैंने रेलवे की प्रॉपर्टी पर लैंड पर प्रॉपर्टी बना दी, बना के जब मैं कस्टमर को जब बेच रहा हूँ, उस समय की जीएसटी की बात कर रहा हूँ।
कस्टमर को आप जो भी बेचोगे उसमें तो आपको 1/3 डिडक्शन टुवर्ड वैल्यू ऑफ लैंड और उस तरीके से मिलेगा, 5%, 1% जो भी है ना।
इसमें सवाल ये आ रहा था कि ये जो लीज है, मैं तो जस्ट सेल की जैसी ट्रांजेक्शन है, बट इट इज नॉट अ सेल बिकॉज आई डोंट हैव ए राइट टू सेल, आई हैव ए राइट टू सबलीज ओनली।
नो, आई अंडरस्टूड सर, बट 30 इयर्स के ऊपर की जो लीज होती है इट इज कंसिडर्ड एज लैंड ओनली।
नहीं, 30 इयर्स के ऊपर की लीज,
30 इयर्स के ऊपर की जो लीज होती है इज कंसिडर्ड एज इमूवेबल प्रॉपर्टी ओनली, लैंड ओनली। तो 30 इयर्स के ऊपर की आपकी 100 इयर्स की है ना, तो इसके लिए आपको वो 1/3 डिडक्शन मिल जाएगा लैंड का।
अगर ये रेंटिंग ऑफ रेसिडेंशियल प्रॉपर्टी हो गई, रेसिडेंशियल प्रॉपर्टी तो एग्जेम्प्टेड है।
अगर वो एग्जेम्प्टेड है तो आपको जो रेलवे ने आपको रेंट पे दिया है ना सर,
हाँ जी,
तो इसके लिए ये थोड़ा कॉम्प्लिकेटेड है, ये गवर्नमेंट खुद को भी क्लैरिटी नहीं है इस पे कैसे टैक्स करना है।
डिस्प्यूट इसलिए क्रिएट हुआ, रिसेंटली नागपुर डेवलपमेंट अथॉरिटी का नागपुर इंटीग्रेटेड टाउनशिप का सिमिलर केस था। उस केस में एडवांस रूलिंग महाराष्ट्र ने ये कहा कि ये कंस्ट्रक्शन सर्विस मानी जाएगी।
नहीं, अभी देखो मेरा तो ये मानना है सर कि सबसे पहले एडवांस रूलिंग जो है, बिकॉज जी दैट इज एप्लीकेबल ओनली टू द पर्सन हु हैज सॉट फॉर इट।
डेफिनेटली
correct, not to we can't generalize the same,
right,
and you can't take the two different views for two different things, because in the same notification you are saying that if lease proper right I am transferring 30 years or more का जो मैंने लीज ट्रांसफर किया है, तो उस केस में डेवलपमेंट राइट ही हम उसको गिनेंगे और डेवलप ओनर को उसके ऊपर जीएसटी देना पड़ेगा।
राइट,
करेक्ट। और दूसरी तरफ आप बोल रहे हो कि वी विल कंसीडर दिस एज वर्क कॉन्ट्रैक्ट सर्विस, तो इट विल नॉट स्टैंड इन द हायर फोरम।
राइट,
तो दैट इज द व्यू व्हाट आई एम होल्डिंग।
नहीं वो सही, मैंने क्लियर कंफ्यूजन था, मैं अच्छा कुछ क्लैरिटी अगर आपके पास मिल जाए तो।
नहीं, तो आई जनरली डू नॉट प्रेफर टू हैव एनी एआर, बिकॉज़ एआर तो यू नो,
इसमें भी एक राजस्थान का एआर भी डिफरेंट है, फिर राजस्थान इज गिवन अनदर एआर ऑन दिस इशू। इन केस ऑफ हुडको उसमें फिर डिफरेंस ऑफ ओपिनियन है हम दोनों का भी, ये इशू हो पाया था। अच्छा, एक मेरा एक छोटा सा सवाल और था, इन केस ऑफ कमर्शियल प्रॉपर्टी जो वैल्यूएशन ऑफ पीडीआर है, क्या बेसिस होना चाहिए उसका?
इन केस ऑफ
कमर्शियल प्रॉपर्टी, मैंने जॉइंट डेवलपमेंट एग्रीमेंट फॉर कमर्शियल प्रॉपर्टी,
तो टीडीआर तो आपने अगर बाजार से खरीदा है तो जो भाव में खरीदा है ट्रांजैक्शन वैल्यू। नहीं,
लैंड ओनर के साथ जो टीडीआर की बात कर रहा हूं मैं, लैंड ओनर को मैंने 20% कंस्ट्रक्टेड एरिया दिया है, उसका वैल्यूएशन कैसे होगा फॉर द पर्पस ऑफ टीडीआर? टीडीआर की जो
डेवलपमेंट राइट्स,
नहीं, रेसिडेंशियल प्रॉपर्टी है अगर, और आप
कमर्शियल है, रेसिडेंशियल नहीं है,
कॉमर्शियल है ना, तो आपने जो अगर उसको टीडीआर दिया है और उसका कुछ ट्रांजैक्शन वैल्यू है ही नहीं, तो जब आप डेवलपमेंट एग्रीमेंट एंटर करते हो ना सर, तो उस पर स्टैम्प ड्यूटी आप पे करते हो। हमारे महाराष्ट्र में स्टैम्प ड्यूटी लगती है, तो आई बिलीव वेस्ट बंगाल में भी लगती होगी।
नहीं, असम में, मैं असम से बोल रहा हूँ, असम में नहीं लगती है।
अच्छा, तो फिर एनालाइज करना पड़ेगा उसको, देन यू हैव टू सी व्हाट इज द मार्केट वैल्यू, बिकॉज यू हैव टू सी व्हेन द कंसिडरेशन इज इन काइंड, so you have to go with the valuation rule. First it says that you have to see the market value.
तो मैं कंस्ट्रक्शन प्लस 10% कर सकता हूँ, कंस्ट्रक्शन कॉस्ट ऑफ द बिल्डर,
that is the last option what you have, construction plus 10%.
that is वो अगर करते हैं तो उसमें डिस्प्यूट की स्कोप रहती है क्या?
नहीं, इसमें कोई डिस्प्यूट ही नहीं है, बिकॉज आप मार्केट वैल्यू निकाल ही नहीं सकते। स्टैम्प ड्यूटी वैल्यूएशन होता तो मेरे पास कुछ मार्केट वैल्यूएशन होता उसका, आपकी इधर स्टैम्प ड्यूटी लगती नहीं है, तो आपके पास वही एक ऑप्शन बचता है।
ओके, थैंक यू।
So can I ask questions?
Yes, sir. Please go on.
Sir, this suppose I sell a flat for 45 lakhs, including the land cost of the undivided portion of the land cost. Then in the return, I should say 45 lakhs or 30 lakhs is the cost of the building.
Return it will be 30 lakhs, because invoice you will say 45 lakh, 1/3 deduction toward value of land, and then 30 lakh.
So in the return, I should show 30 lakhs.
Return will show 30 lakhs, but इन केस ऑफ 33 लाख, सपोज 48 लाख का होगा या 47 का होगा, तो आपको 5% में जाना पड़ेगा. So 45 lakh is the gross amount. It is not taxable value.
Okay. Gross amount, yes. Taxable
Yeah.
value, I should say 30 lakhs.
Taxable value is 30 lakhs, but the gross value is 45 lakhs.
Achha. Like that, we have to mention that in that.
Yeah.
In that.
Yes, sir.
Written by, the mention is taxable value is 30 lakhs only.
30 value, taxable value 30 lakhs in the return, and on that you have to charge 1.5% GST.
If I'm taking in different stages the installment, say stage 1, stage 2, stage 3.
Correct.
So each time I have to deduct 1/3 of that value, 10
Yeah,
lakhs.
yeah. So suppose 45 lakh का sir आपने 15 लाख 3 stage में लिया. So once you take 15 lakh, so you will say you will issue invoice 15 lakh gross value. The 1/3 deduction toward value of land 5 lakh. Taxable value 10 lakh. On 10 lakhs you will charge 1.5% as GST, and accordingly you will file your GSTR1.
Yeah, thank you. Thank you. That's why I wanted to.
Yeah. Okay.
Because people are saying that 15 lakhs, 1% they are charging.
No. 50 lakhs पे नहीं होगा sir. 50 lakhs पे तो आपको 5 पे आ जाना पड़ेगा.
No, they are putting like this invoice: 15 lakhs, 1% GST, 1.5 lakhs, and then they are putting it 16.5.
No.
And that's why I wanted to ask you that question. That they should deduct each invoice the 1/3 as the.
1/3 each invoice पे आपको दिखाना है सर. GSTR1 में भी accordingly आएगा.
Thank you.
Yes, sir.
हेलो.
हाँ बोलिए सर.
सर मैं दिलीप बोल रहा हूँ. मेरा एक क्लाइंट है, उसका लैंड डेवलपमेंट जो कोलैबोरेशन लैंड डेवलपमेंट एग्रीमेंट हुआ है, उसमें मेंशन हुआ है उसका शेयर, जितना शेयर है उसका अलॉटेड है, और कस्टमर जो बुकिंग करेगा वो डायरेक्ट वो लैंड ओनर को भी पेमेंट करेगा. उसमें क्या जीएसटी में रिवर्स चार्जेस में आएगा जो डेवलपर?
रेवेन्यू शेयरिंग का आप बात कर रहे हैं ना?
हाँ, रेवेन्यू शेयरिंग.
रेवेन्यू शेयरिंग का एग्रीमेंट है, तो रेवेन्यू शेयरिंग पे ऑलरेडी हमने डिस्कस किया कि जो भी डेवलपर है वो अपने पोर्शन का जीएसटी भरेगा, और जो ओनर है वो अपने पोर्शन का जीएसटी भरेगा.
सर
सपोज 1 करोड़ रुपए का फ्लैट है, 1 करोड़ में से 60 लाख डेवलपर को जाना है और 40 लाख ओनर को जाना है. ठीक है
जी.
40 लाख पे ओनर विल पे जीएसटी एंड 1 करोड़ पे डेवलपर, सॉरी 60 लाख पे डेवलपर विल पे जीएसटी ना.
नहीं, इन लोगों का केस में क्या होता है, ये डुप्लेक्स है, उसमें कस्टमर जो बुकिंग करता है डायरेक्ट लैंड ओनर को पेमेंट करता है, लेकिन डेवलपर जो है वो डेवलप करता है, लेकिन लैंड ओनर डायरेक्ट पेमेंट करता है. लैंड ओनर पैसा लेता है कस्टमर से डायरेक्ट. उसी के साथ
उससे कुछ फर्क नहीं पड़ रहा, लेकिन लैंड ओनर जो है वो कलेक्ट कर रहा है डेवलपर के ही बिहाफ पे ना वो पैसा. तो
हाँ.
तो हमने डिस्कस किया ही था कि इसके पहले किसी ने पूछा था, तो उसमें डेवलपर कलेक्ट कर रहा था, लैंड ओनर को दे रहा था. आपके केस में उल्टा है. आंसर विल रिमेन सेम.
तो मतलब उसमें जीएसटी में आएगा?
हाँ, जीएसटी आएगा.
थैंक यू.
सर वन लास्ट क्वेश्चन.
क्या हर्षित जी?
सर जो अपना 80-20% का जो रेशियो है रजिस्टर्ड अनरजिस्टर्ड का, उसमें 20% में अगर मैं किसी से सर्विस ले रहा हूँ, जस्ट वो कॉन्ट्रैक्टर जो अनरजिस्टर्ड है उसमें 20% में, तो वो भी फॉल करेगा सर?
हाँ, वो भी फॉल करेगा.
तो अल्टीमेटली मेरा अनरजिस्टर्ड परचेज प्लस अनरजिस्टर्ड सर्विस दोनों मेरा
अनरजिस्टर्ड गुड्स, अनरजिस्टर्ड सर्विस, और अगर आपने किसी एग्जाम सप्लाई भी लिया है तो वो भी इसमें फॉल करेगा.
एग्जाम सप्लाई जैसे
कोई भी एग्जाम सप्लाई हो सकता है ना, जिसके ऊपर की जीएसटी नहीं है, ऐसा कुछ आइटम आपने परचेज किया.
ओके.
क्या तिवड़ेवाल जी?
हेलो.
क्या वेदांत जी?
I have a question. एक joint venture agreement है revenue sharing. So the developer is taking the entire amount, and can he discharge the entire amount of GST and then remit the amount to the landowner, or will both landowner as well as the developer have to take separate registrations?
See, the developer or the promoter. Here they have said not the developer. In the GST law, they have said promoter is liable to pay. And once you go to the definition of promoter, they are saying landowner is also promoter and the developer is also promoter, because they are referring to the RERA law. RERA law, if you go RERA law, consider both as a promoter of the property. Correct? So of course, so in that scenario, landowner is also liable to pay GST on his portion. So I am holding a view that both should discharge their own liability instead of one person discharging the liability of both. Otherwise, the liability of owner will remain as it is. No?
But the entire liability actually is being discharged by the developer because he is collecting the entire amount and then remitting the landowner's share back to him.
Okay, so I will, Vedanji, I understood. So suppose Vedanji, you come to me and you took some opinion from me and I said, okay, I will charge 50,000 rupees plus GST. So can you say that, okay, you don't charge GST, I will pay the GST on your behalf and the department will not do anything to me? So then we can argue कि already transaction पे जो GST लगना चाहिए वेदांत जी ने pay कर दिया है, so now I am not liable to pay.
Okay. So from that
the person who is liable to pay already has been defined. So accordingly, the same person has to pay. No, another person cannot pay on his behalf. That is what the view I am holding.
So even if the joint venture agreement specifically mentions that the entire amount will be disbursed by the developer pertaining to the taxes, even then this will not be taken as a recourse.
Yeah, because the agreement is already there between owner and the developer, and whatever he is collecting is on the behalf of landowner only. Na?
Yeah, so
Money
even if the joint venture
to
agreement, correct. So even if the joint venture agreement specifically mentions that the entire amount of taxes will be collected by the developer and will be discharged by him, even pertaining to the landowner's portion, even that will not suffice. I mean, he cannot take recourse to that point.
That is the view what I am holding. Because the owner will have in his balance sheet the amount, P&L amount will have, then the authority will say, where is the GST on this?
Okay.
That agreement will become ultra. So this will be the last. So this will be the last question, sir, because we also need to wrap up the session. So this will be the last question. Yes,
I have asked a question in the chat box. Can you?
So we can take your question and that's it, sir. If you can just spell out your question.
Yeah. In case of joint development agreements for commercial properties, it is a area sharing model. So after the completion certificate is obtained, the developer will hand over the 25% of the share to the landowner. Now, what will be the effect of the GST on that portion for commercial projects?
So commercial project we are talking, correct?
Yeah, correct.
So whatever 25% portion is giving, so on that developer will pay GST at the rate of 12%.
Okay.
At the time of possession.
So the rate will be decided by the nearest rate to the completion. The taxable value of.
Okay. Taxable value.
Yeah.
So one way of looking at it as a taxable value is that you can go with the 1%, the first flat what has been sold.
First flat. Okay.
First flat has been sold, whatever has been sold to independent buyer.
Okay, sir, the first flat is sold at suppose in the year 2022 and the completion is on 2026. Obviously, the rate will be higher.
Pay GST on in 26 at the rate of 22.
At the at the rate of 22, we pay the GST. And sir, for the ultimate buyers also the rate is 12% only. That the developer will collect 12% only.
Correct? 12%.
They won't collect 18%.
No, 12%.
Okay, thank you, sir.
Thank you so much, sir. We will conclude the question answer session here. Just seeing at the time, sir. So, sir, I will just I would like to thank you for giving us such an enlightening session on the GST and clearing out all the doubts. I'm sure if you can see from the response of from the attendees also, with so many questions coming up, that everyone most of the doubts has been cleared, and there were so many questions that came up also. And if you can see the chat box also, everyone has been asking for the video also of this session, and they really are looking forward to the presentation also that you have shared. So just letting everyone know that today's session was also live on YouTube, and it has been recorded on YouTube. So on YouTube, you can find the session at any point of time. And the presentation, as soon as sir shares with us, we will share with all the attendees. With that, sir, once again, I would like to thank you for sparing your time and giving us your valuable time and coming to this Views Exchange platform and giving your valuable inputs on the topic. Thank you so much, sir. Thank you so much, sir.
It's my pleasure to be here. Thank you very much.
Thank you, sir.
Thank you, sir.
Giving time. Thank you, Umang, and thank you each and everyone who have joined in. Thank you so much. We are concluding the session. Thank you, sir.